Please take your seats. Axios BFD San Francisco is about to get started.
Every day, every single day, things are happening in the world of deals and deal makers. And there's never enough time to keep up with every company, transaction, announcement, or whatever. It's just exhausting. And we have a new product to help fix that. This is Axios Pro Deals, a new premium subscription product bringing you tailor-made insights like never before. For the last 5 years, Axios has helped deal professionals navigate the whole deal landscape with Pro Rata. With Axios Pro Deals, we're diving deeper into the industries that matter most to you. You just want stories on fintech? There's a newsletter for that. MedTech deals? We've got you covered. The future of retail? We'll guide you. With Axios Pro Deals, you're going to be getting all of this industry-specific insight and expert analysis at a level you simply can't get anywhere else. So if you're a venture capitalist, private equity investor, banker, trader, founder, executive, anyone who cares about deals, Axios Pro is what you need to help you understand what matters and why. Start your free trial today at AxiosPro.com.
Please take your seats. The show will start in 60 seconds.
Welcome aboard.
Can I watch that or not?
things off for this afternoon, please welcome Axios CEO Jim Vandehei and Axios SVP of Events and Creative Strategy, Kristen Burkhalter.
Thank you all for coming. I'm Jim Vandehei. I'm the CEO of Axios, one of the co-founders. Kristen Burkhalter runs basically Axios. Is the reason that events like this happen. This is our second BFD event. We all know you're here because you're Dan Primack groupies. We did a BFD event in New York last year that was a huge hit, and so we're glad to bring it to the West Coast. Really excited for all of you to be able to spend time getting to know not just Primack, but our pro team. We have these deals verticals. If you're not a pro subscriber, you should become one. You can do that today. We can make that happen for you to be able to meet some of our business reporters. Obviously, we're in Washington, so we do a lot of political coverage, but we have way more people covering deals, technology, and business than we do politics or media. So our hope is you have a great time listening to these smart guests and smart reporters and getting to know each other if you don't know each other already. Hopefully I get to meet a lot of you as we mingle throughout the day. I do want to thank a couple of Axions who you're going to hear from. George Moriarty, who's sort of the mastermind, the editor of all of our pro products. Dan Primack, Aaron Brodwin, Hope King, and Kia Kokliacheva. And who else am I missing?
We have many, many people to thank. But thanks, Jim. Jim is our BFD. I, of course, need to thank our awesome sponsors, Latham & Watkins, as well as JP Morgan, our amazing production team, CSL, that goes on the road with us all over the world, Dynamite Digital, Terra Gallery for putting this together, Foxtail Catering, Alto, that offered a ride share for us, and then my awesome events team who really did put all of this together. This is an awesome group. We have an awesome lineup today. We have a happy hour after you get to be a part of all of these amazing conversations. Stick around. We hope to meet you. And I think let's get started.
Awesome. Thank you all.
And next, Axios business editor and author of the Pro Rata newsletter, Dan Primack.
Hello! Hey, thank you all so much for coming to San Francisco for our first BFD on the West Coast. I hope and I think this, to me at least, feels like a little bit like taking Pro Rata, which I write each morning, and bringing it to life to kind of talk to the people and understand the topics that are a BFD. So we're going to kick it off. My first guest kind of started his company when he was a senior citizen, kind of at the age of 19. Stripe, for those who don't know, it's kind of this middleman for kind of all your digital payments. Often if you buy something at Amazon, if you take a ride in Uber, if you buy an Axios Pro subscription, you are using Stripe. So please welcome John Collison. John, you wrote, you and Patrick, your brother, you guys wrote kind of your annual letter. And in there, it said that Stripe's mission is to grow the GDP of the internet. But the internet is now kind of ubiquitous. So what does it really mean to grow the GDP of the internet?
Well, it is and it isn't. I think it's certainly much more ubiquitous than it was, say, in 2009 when we started writing Stripe. At the same time, remember, 2009 when we started building Stripe, it felt like this internet, it was 8 years post the dot-com crash. If you went up to people in 2009 and said to them, hey, the internet's going to be a big thing, they give you kind of a blank stare, yes, I know that. And so I think in 2009, people felt like it had been played out. And kind of similarly now, you feel like it,
But if not played out, like how do you distinguish between when you say grow GDP of the internet of that and kind of the economy as a whole, or at least the retail economy as a whole?
So we've a specific, and in some places we flesh this out a bit more. We've kind of some specific ways in which we think the infrastructure available to businesses and startups and developers is holding back the amount of commerce that could take place online. And we think the internet is a key component. But you're right that it is kind of becoming injected in everywhere. Specifically, we think it's way too hard to start a business. And it could, you look at many of the things that Stripe does, whether it be, Stripe Atlas for incorporation and payment links, it's making it easier to start a business. And it's still the case that there's way too little cross-border commerce. And so, we, by making a global platform that makes it easy to accept money from anyone in the world. Axios just wants people to be able to subscribe and doesn't want all the payments drudgery to get in the way. We think you can grow the internet economy that way. And so those are kind of some of the specific ways in which we think Stripe can grow the GDP of the internet. But you're right that it's becoming a pretty big share of overall commerce.
Stripe, you guys processed $817 billion, I think, last year in 22. Do you cross $1 trillion this year? Is that your expectation?
We will have to, it'll be...
You're 4.5 months in. You might have 5 months in. You might have a sense.
It'll be in that general vicinity.
Okay, that general vicinity. Well, okay, so let me ask. So you guys had a good, you had, by most companies' accounts, a good growth trajectory last year, 26%, but that was slower than 2020, slower than 2021. Should we view Stripe's growth or slowing growth or accelerating growth as a bit of an avatar for the overall U.S. economy?
Not too much, because, for example, in 2021, we grew, I think it was, let me get my numbers right here. In 21, we grew, I think it was 60%, and we, said at the time in that, annual letter that, please do not expect this growth in future years. It's kind of anomalous, but obviously the the U.S. economy was not growing at 60% in that year. And so I think we tend to see in our data a lot of the effects of, what is happening to internet companies and SaaS and e-commerce and kind of a mixture of segments there. You can't reason too much about any one segment like e-commerce, but you can reason about how the top line growth of how the general digital sector is doing. I think you can draw some conclusions there. But at the same time, I think people probably fixate a little bit too much on the latest print as opposed to what are the long-term growth trends.
So I guess the reason I'm asking is, and you're right, obviously Stripe's growth or not is not the exact same as US GDP. I guess here's what I'm getting at. When you look at your data and you see what's coming through, do you get a sense on whether this country at least is heading toward a recession or not?
I don't think we have the right data for that, because that's a pretty technical matter, and a 1 point swing makes a difference. And so I don't think we have the data to answer that.
Are you as a company does it matter to you? In other words, if we flip into negative, does that matter to Stripe in terms of how you allocate resources, in terms of how you spend?
We definitely are planning and have been planning for a while for a much weaker environment over the next, say, 2 years than we have seen over the previous 2 years. And so kind of yes, in that regard, we are planning for a recession where we just want to be able to kind of handle that.
The letter had a lot of numbers in terms of growth and customer, et cetera. There were two big ones, though, that was missing, revenue and earnings. Would you like to share revenue or earnings?
No.
No. Okay, so I'm curious, is part of that the reason you haven't gone public yet? A lack of desire to share kind of top line numbers?
They're not that much of a secret in that revenue you could probably make.
Well, okay, so let me then. That's fair. So let me ask you. Bloomberg reported last year negative $80 million in EBITDA. Accurate?
So I'm not going to confirm or not confirm.
He says it's not that big a secret, so we can share. No one's watching.
No, but what I will say is just again, revenue you can kind of back into if you want. Earnings, we have basically historically run the business on a kind of break-even basis where it's been self-funding, and that's actually pretty important as a conceptual matter to us, where earnings for a bunch of other companies, like within our industry, people are very obsessed with earnings and what's your operating margin and things like that. And if you look at this kind of a cohort of various legacy players, acquirers, the World Pays and FIS and First Data and things like that are kind of run on an earnings basis where people follow the earnings data very closely. I think the big place where Patrick and I and Stripe more broadly disagree with the industry is that we think the internet economy is going to be massive and there's all sorts of big opportunity there. And so why would you overly focus right now on kind of minimizing R&D spend so that you can drive near-term profitability? Stripe has always spent much more on R&D than everyone else in the industry, and that's kind of a strategic difference, such that as a result, it's kind of less satisfying to follow along Stripe's earnings.
So, some of your competitors, PayPal, obviously, Adyen, are publicly traded. When they come out with their numbers, what is it you look at?
We tend to look at just top line growth of all companies. Within payments, but Visa, MasterCard, Microsoft, Google. I think it's just kind of useful to get a sense of where digital ad spend is growing where it's like pretty flat at the moment, where kind of core payments is going Visa and MasterCard, which I think is in the 6 to 9% range. We kind of follow those numbers. Again, I think those numbers tell you something about what is happening in the industry broadly. I think looking at people's bottom line performance tells you about kind of what analysts thought and what's happening in kind of their specific business, which probably has less relevance for us.
You and I last did something like this, I think it was about 5 years ago in Las Vegas at Money 2020, and I'm pretty sure, I couldn't find a video I searched for. I believe a lot of our conversation, though, was when's Stripe going to go public, and you...
I wonder who would have set that agenda, yeah.
Yeah, so I don't ask it with a time, because I know you're not going to give me one, but the company's been around a while. What's the main argument for not being public at this point? And I guess I ask in the context, you guys obviously just did this big fundraise, which was really not for the company. It was to help employees satisfy tax obligations because the RSUs were coming to a time limit. An IPO would have solved that problem. You wouldn't have had to go to the private markets for that, among other things it would have solved.
Yeah, I mean, I think you narrowly on that transaction.
5 years ago, you were an outlier. Now you're a big outlier.
We're not that much. I mean, there are other companies in our position, but kind of narrowly on that transaction, we just looked at the world in Q1 2023, and it didn't seem like a phenomenal time to go public. And yet we had kind of, for a bunch of technical reasons, these kind of expiry issues with comp, and we very much care about employees, and there's a large employee ownership at Stripe, and very much wanted to do right by them. And so this was our solution to that, which, again, we didn't know, you and I talked about this, we really didn't know how it was going to end up, what the private market reception was going to be, but it ended up in a pretty nice spot. More broadly, I think Silicon Valley gets a bit obsessed with transactions and IPOs and
it's literally my life.
Outcomes, exactly. Yeah, I was saying Silicon Valley to be polite, but yes, and pro rata, I guess, is literally what you write a newsletter about. But look, we're just focused on building something useful for people and like having a good business that is self-funding. And I think what the finer grained mechanics of the capital structure at the end of the day, I think are less important than, is this a really good business? Because ultimately, millions of businesses around the world find it useful as a way to reach their customers.
You said, obviously, Q1 23, you're right, it's not a very good time to go public. If Q1 23 was the same environment that had been, say, 12 or 15 months earlier, do you think you would have?
I think that's in the category of revenue and earnings of questions we can't.
No answer. Fair enough. Let me actually ask one final question about that finance round, because I'm just curious, because I realize I don't know. So the finance round, again, was to satisfy tax obligations. There was a secondary or a tender for employees. As a piece of that, you guys ended up raising, in terms of cash, or bringing in more than you had expected to, a slightly lower valuation too. Since you got more than you expected, where did that extra money go? Was that just to satisfy oversubscriptions on the tender?
No, the legal and finance teams organized it so that there was kind of flex in how the amount works. And so kind of the publicly reported amount was a committed amount. But we'll need to raise as much as is actually needed. So.
The valuation cut down to $50 billion. How did you message that to employees who are sitting there saying, wait, the company I'm working for just lost 45% of its value on paper?
Oh, I think people are, look, no one likes looking at, their holdings and seeing the number go down. But the only difference between the private markets and the public markets are whether you see that happen gradually or suddenly in kind of a step change format. But I think people looked around them and saw high growth peers trade down 50, 70, 80%. And it's not that surprising that Stripe is not trading at the peak of what it traded at in 2021.
I'm curious, is there something that you believed at this time last year, May of 22, that you now think quite differently about in terms of Stripe's business or the market as a whole?
Nothing radically different about Stripe's business. I mean, I think there's certain things that we have finer grained, just we have more depth and precision on as we look at various parts of the business. I think broadly, people during COVID maybe overestimated the long-term change a bit. Like, people in the middle of 2020 and 2021 were putting out all these grand prognostications about the future of work and stuff. And some things have materially changed, But I think people maybe overestimated the long-term change about it.
Speaking of overestimated, one of the things that Stripe did during kind of the post-pandemic time was, and you and Patrick have acknowledged this, overhired, and obviously you had to have some painful layoffs, around 1,100 people. We've seen some companies, large tech companies in the Valley, do a large layoff and then have to come back 5 months, 6 months later and do another one. Is there a chance Stripe will have to do another large layoff?
We sized the layoff that we did. Again, when you're saying kind of, are we planning for a recession? We sized, you want to cut once and cut deep. We sized things such that what is the team that we want to have going into what could be a fairly grim, economic climate. And so I feel quite good about Stripe's positioning going into if things get, a fair bit worse. And then there could be upside from there where, you look at certain scenarios and actually, things end up quite a bit rosier.
Recently, you interviewed Sam Altman, the OpenAI CEO, on stage. I'm curious, and you talked to him for a while, what was a takeaway for you about how you think AI is going to fundamentally change Stripe's business?
I think we should all be very excited about AI. I'm contrarian opinion in San Francisco, I know. But I don't buy any of the doom stuff. I think it'll all be fine. I don't think one should be that worried. But I think there's just some very meaningful productivity improvements. And one way you can look at it is anywhere at Stripe where there's someone doing stuff. You have, how should you model kind of LLMs, and maybe a better version of LLMs, like the accuracy isn't that good there. And one thing Sam and I talked about is it feels like we will solve the accuracy issue so that they're not just making shit up. But anyway, so as you have, stop the hallucinating problem, as they say in kind of the AI speak. And so as you have good tools like that, you can kind of view it as everyone at Stripe has a team of smart, motivated research assistants kind of at their side as they work. That's like a pretty big deal in terms of productivity. And so, macroeconomists like to complain about, stagnation and, where's total factor productivity going and everything like that. I think we should be pretty excited about AI just making everyone more productive. And that's certainly how we're reviewing it at Stripe, where we are trying to make this very broad-based, where it's not a top-down AI mandate of, we're going to put this in our product or that in our product. What we're trying to do is just get LLMs in the hands of everyone at Stripe so they can just figure out themselves how it best applies to their work. And then you see a lot of bottoms-up stuff where people are, finding that database query optimization works really well, or, all this other stuff. But at Stripe, at least, it's very bottoms-up in how it works, as opposed to coming up with, the new top-down AI rules or something.
It's interesting. When I was looking at videos of you recently, in addition to the one with Sam, you interviewed Stanley Druckenmiller at some conference. So I'm just curious, are you a frustrated journalist at heart? Do you want my job just with a better paycheck?
Oh, don't worry. We'll get to the Axios revenue and earnings later on. Yeah.
We've already been acquired. We're done. Actually, when's the last time Stripe got a takeover offer or an approach? How long has it been?
I can't remember, and if I could, I couldn't tell you.
Fair enough. Several years ago, Stripe made news by basically walking away from crypto, or from serving crypto. Then you again made news last year by returning to it. I guess my question for you isn't so much why walk away and come back, but at this point, how much of Stripe's resources are you allocating to it? Is it kind of, from your perspective, a small part of the business and something you should have because there's some customers who want it, or do you really see it as an integral part of the company's future?
TBD on integral part of the company's future. It could be. Crypto is very kind of cultish, where there can be a bit of a, at least on Twitter, you're either with us or you're against us. And so we didn't walk away from crypto. We just had a specific crypto product, which is Bitcoin payments, that we shut down in, I want to say 2015.
Yeah,
because Bitcoin at the time, this was pre-Lightning and everything, it's a terrible payment method. It just didn't work well, and as a result, our businesses didn't want it. But we weren't saying crypto is bad or anything like that. We were just saying no one wants this product that we built, so stop doing that. And then later on, we built. We were very excited about this. Global payouts. When you think about, one thing you might want to use Stripe for is, we have a lot of marketplace type businesses like the Ubers and Airbnbs and people like that. Accepting money is one thing. Paying out money to the rest of the world, and especially long-tail countries with poor banking rails, is another thing. And so we built USDC payouts on the Ethereum Polygon L2. And that works really well for actually paying out money to long-tail countries. And it works better than fiat payments in a lot of cases. And so we're just looking for places where crypto can actually be useful in solving real business problems. The other thing I'll just say is I think people kind of judge crypto based on the batting average, whereas at least for our purposes...
What do you mean by batting average?
Like, what fraction of things in crypto work? And I think, the crypto haters will look and say, see, no one's buying NFTs anymore, and see, this turned out to be a scam, whatever. And so they will kind of judge based on the percentage of things that turn out to work. But for our purposes, we just care about what absolute number of crypto technologies are useful. And again, we're quite bullish on stablecoins, we're quite bullish on, some of the other connectivity.
Okay, so you said it remains to be seen how much of the company, but if you, for example, think, and this might just be a reflection of the way you hired, but if you think of the layoffs, the folks who at least were dedicated on the crypto side, more or less than the mean?
Oh, sorry, I did not answer your question. Like in terms of people working directly on crypto products at Stripe, it's small. It's around 20 or something like that. It's a small but very productive actually team.
One of the other things you said in the letter in terms of numbers was that 55% of new customers to Stripe last year were non-US or were international. Is that the biggest growth opportunity for you outside the US? In other words, does that number at some point have to be even higher than 55% for the company to maintain the growth trajectory you want?
The US is a very large and successful and productive economy, and I think you see this in even kind of a scale business like Google or Microsoft will make a huge amount of its money in the US, and I basically agree with Buffett's never bet against America take. International growth is for sure a pretty big vector for us, and we're quite mature in the US and say Western Europe, but still expanding very rapidly in places like Latin America and the Middle East and Southeast Asia and stuff like that, where there's super interesting stuff going on in payments. Like, it's really not a written book. We have lots of other axes of expansion. Upmarket is something that's very big for us. You probably saw our Amazon news a little while ago, and we got our start in startups, but now enterprise customers are growing significantly faster than kind of the overall part of the book. So that's a big area. And then we spent a lot of our time, we just had our customer conference last week, we spent a lot of time talking about our revenue and finance automation suite, where this is basically Stripe getting into much more of the software of running your business. Think like managing sales tax and subscription billing and stuff like that. So there's kind of multiple growth angles. So international is for sure a big one, though, the US is still a pretty effective economy.
A big conversation, obviously, in San Francisco, and it has been for a couple of years, and you kind of referenced this earlier, is remote work. So I am curious, you live here. You also, obviously, you're from Ireland. You just bought I wrote this down because it's massive, a 27,000 square foot, 18th century estate in Ireland. It's got 1,100 acres. Are you planning to live there, and are you about to be a remote worker from a small, apparently, condo in Ireland?
Exactly, yeah. No, I'm mostly here these days. So I love going home, and I spend a bunch of time at home as well. But somehow, Patrick and I are a sucker for work, and so we have Stripe and we have Arc, this biomedical.
And it takes forever to mow that lawn. That's a lot of work.
Exactly, and it turns out maintaining an 18th century kind of listed old house is a lot of work, but it's quite fun.
John, thank you very much.
It's been super fun.
Appreciate it. Hey, come on. I do want you all to know that we have this content. We also, again, are going to have happy hour when all the content is over. And we had a quick little fire drill yesterday. And thank you, Hannah, on our team. There will be TVs down there for the basketball game. We had to make sure of that. Just in case you were worried. Our next guest is the 9th CEO of the nation's largest public pension fund, CalPERS CEO, Marcy Frost. So, Marcy, as I said, CalPERS is the largest public pension fund in the U.S., $440 billion as of the last fiscal year. You also run one of the country's largest kind of advocates, you could say, public advocates, for using ESG as a lens for investing. So, outside the acronym, what does ESG actually mean to you in CalPERS?
Yeah, I really appreciate that question. I'm sure you're all aware of this ESG, anti-ESG debate that's going on, primarily, frankly, here in the United States. But for us, ESG really has not changed that much over the last 15 years. It's a way of looking at our assets. It's a way of looking at the investment decisions that we're making today to make sure that they can stand up to issues around climate, extreme weather, whatever you want to call it, human capital issues and governance issues with boards. And so we have been a long-standing advocate on getting regulations passed, better transparency, But now we're also beginning to see some integration, some deals that are coming our way that might be more climate or energy related. So that's been an emerging topic for us, but ESG really has been a risk and opportunity lens. And in the last 10 years, I would say it's been more of a risk lens.
One of the examples you recently gave, I think when talking maybe to your board, was the CalPERS looked, for example, at a bunch of its real estate investments to judge how much was coastal, how much of that was potentially threatened. What does that mean? Does that mean you divest things? What does that actually mean?
No, we're not divesting from really anything right now, and that might be a topic we want to talk about. But we really wanted to understand the longer-term risks. Some of these assets have been in the portfolio for quite some time. Most of our commercial real estate is urban and coastal. And so we need to make sure that the valuations coming in on those properties accurately reflect what might happen over time. We're a long-term investor. We're invested in these markets for 20, 30, 40, 50 years, and we're holding these assets for that same time frame. So the valuations as they're coming in, if we see a mismatch in what we're seeing in our own risk analysis to what the valuations are coming in, we're going to have a lot of questions about that. We have to price that appropriately within the portfolio. So it's just again, through that risk lens, understanding where we may have upcoming risks that are not priced.
How do you track ESG? And I guess because it's a strange acronym because the three things don't necessarily have anything to do with one another, but they all get lumped together. So, I guess from a real pragmatic brass tack standpoint, how do you actually track it? I mean, is there a piece of software you use? How do you determine that? And is there a score when you look at your investments? This has a 90, this has an 80?
Yeah. So there really isn't a common definition of ESG. I think you can talk to 10 different investors and come up with 10 different definitions. But for us, it's really understanding on the E side, it is the transparency around greenhouse gas emissions, around just energy transition. On the S, it's really around human capital practices within a public company or a private company. And then the G is really the governance around the board. So measurements have been difficult because the data has been quite elusive. Trying to get the markets and the issuers to provide the data that we need to make that assessment has been a bit challenging here in the US. Now, internationally, we're seeing that happen at a faster pace than what we're seeing it here in the US. But the SEC, as you know, is under challenge for promulgating some rules around transparency. But until we get the data, it's very difficult to measure.
You've said that you believe a lot of the political blowback against ESG investing has been a misunderstanding of ESG. Mm-hmm. Isn't it possible they actually do understand and they just don't like it?
It's always possible, right? It's always possible. Policymakers have an agenda that might be different than the agenda of an investor like CalPERS. And when some of that money is being poured into those policymakers' campaigns from the oil and gas industry, as one example, that does create a mismatch between a policymaker and an investor like CalPERS. So, our approach really has been explain what we're doing, the why of what we're doing, and really reinforcing that the fact that we're looking at this is that we pay 2 million members a retirement benefit for their lifetime, and that's all that matters.
You say that's all that matters. So if you had an investment opportunity that, for lack of a better term, failed your ESG metrics and didn't burn them to the ground, but you thought it was a good investment from pure dollars and cents, you make the investment?
Yes.
Yeah.
It's the difference between that values, so we all have our personal values in the way that we invest our own portfolios. But when you bring your personal values in as a fiduciary of a trust fund, $440 billion as of June or as of March, you have to set those aside a bit and understand whether that value, that personal value you have, actually creates value for the 2 million beneficiaries. So if we find an opportunity that may fail a few of our due diligence on climate, it doesn't mean we'd walk away from that deal today. We would be a very active voice on how they're going to transition that asset into something that might be cleaner long term.
What does it mean to be an active voice? So you're a shareholder, you're not a control shareholder, most likely of this company, probably very small. Yeah. How loud do you feel you can be? You're obviously not an activist investor at least in that traditional sense. How do you get your voice heard? Is it simple? How do you do that? Mm-hmm.
Well, I think part of it is being a respected investor by these companies. And so when we make a phone call, whether that's a private phone call, and we do a lot of private engagement, that they actually listen to what we're requesting. So whether that is data around scope 1, scope 2 emissions or capital expenditures that they're planning on 2030, 2035, we're actually getting a pretty warm reception to those questions and actually getting answers that we appreciate and like. But we have proxy, proxy season. We can make our voice heard with a number of other investors. But I think you introduced this as CalPERS being the largest in the U.S. public pension plan. I think being the largest actually amplifies your voice. And so we can use channels that may not be available to smaller investment funds.
So let me actually ask you about that. There's a bill right now before the state Senate that would require CalPERS and CalSTRS, the teachers' pension fund here in the state, to stop investing in fossil fuel companies, specifically the 200 largest publicly traded fossil fuel companies, and eventually divest any existing investments. You're opposed to that. Why?
I am opposed to that. Our board is opposed to that. They supported...
Except one member. You have one.
We had one. Maybe two, who supported the staff recommendation, which was to stay in. So our plan on getting net zero by 2050 isn't to shed the assets. Because we think that we have these relationships, because we think we have an active voice that actually matters to these companies, we think staying in is the right answer today. But on that path to net zero, there may come a time where we don't believe that the company is standing up to what they've told us. So that might be a time that we walk away from a company, but walking away from a sector when you know the energy companies are going to figure this out over time. It's just trying to figure out the timeline by which this will happen.
Do you feel in your position, I guess you could say for the CalPERS board position, like you're in a strange spot with no friends when it comes to these issues because you're pro ESG very loudly, and so you get hit from the right. You're against this bill, which is obviously being pushed in California by the left. You don't seem to have a friend anywhere to run to on any of this.
No, the friends really are the beneficiaries, right? They're the beneficiaries of the system that we feel that, we're a 70% funded system today. That really limits your opportunity set. So back to the question of would we invest in something that may not meet all of our ESG standards? The reason for that is, one, we have a fiduciary duty to do that. But two, we're only 70% funded as a pension fund. And we're also looking at rising employer contribution rates, which is really quite threatening to a defined benefit plan. So SB 252, yeah, we're not making friends on either side of this issue, but that's probably okay. If you're making both sides equally unhappy, you're probably somewhere on the right track.
Would you like to make a prediction what's going to happen in the Senate with this bill?
I could.
I think you should.
I think... All right. I think it's going to pass. That would be my prediction, is that it will pass. And the reason I say that is there is language in this bill that basically puts a caveat that the board of CalPERS and CalSTRS, the boards, do not have to divest from these assets if it is against their fiduciary duty. And so the board has already stated very clearly that this is a violation of their fiduciary duty. And so my belief is because that caveat is in there, there's really nothing to lose with passing the bill.
Yeah, I'm curious though. You made the comment that you think that there's a value to staying in these companies because you can, as you said, you can get disclosures, but you can maybe have an influence on them. Mm-hmm. I mean, wouldn't the greatest influence be to walk away and say you can't have our money anymore, and to be loud? Because CalPERS has often said ever since I've been covering stuff for 20 years that people don't blindly follow CalPERS, but when CalPERS speaks, people listen, and sometimes people do follow your path.
Yeah, frankly, I think many of the companies would be relieved if we walked away. And so we don't believe that that's the right approach for us today. We think that on the public equity side, we stay in. We are divested from coal, by the way. So we have made divestment decisions in the past, but there's been a period of time where that has not occurred, which is the right thing for now. But then on the private equity side or the alternative side, we're actually finding opportunities to invest in cleaner energy or energy tech or climate tech.
Can I ask about that? I mean, do you feel you came in at this point 7 years ago, I guess, into CalPERS? Is that right?
2016.
2016. Mm-hmm. CalPERS before you, particularly kind of in the late aughts, had a very bad run of it, particularly investing in venture capital funds, but investing in clean tech projects and companies. Did it take a while, for the institution to kind of get over the PTSD of that to start investing again?
Yeah, I think when you're a long-term investor and you're worried about being able to pay those benefits, that's what keeps you up at night. I think any kind of severe market dislocation does have that ripple effect of do I really want to take this risk on again? But the opportunity set does change over market cycles, so we are finding some really interesting opportunities in venture capital, fairly small for us right now on the private equity side. Hedge funds, the size of CalPERS, the fees within some of the hedge fund structures, likely not there yet, but everything is on the table right now. Everything is on the table.
Let me ask about the last part of ESG, which is governance. Particularly when you are investing in, say, a private equity fund or in a hedge fund or in a venture capital fund. How do you apply the G to that? And I think, for example, you're in a bunch of funds, so these are very small parts because it's indirect, but you're in a bunch of funds that were in FTX, for example. There was no governance there, but you invested in their funds. I mean, does that become something that's a red line? You don't invest in the next fund because of that?
No, I think private equity is a bit different. I think we all, as limited partners, know that when you sign on to private equity, you really have limited governance rights, which is why we are very supportive of ILPA as one example, because that's the LP community coming together to have the same standards for a GP, so that the GPs can't LP shop.
But if a GP then invests in a company like FTX, which basically has no CFO and no board and clearly no controls, doesn't that become a we don't invest in you again, or do we not?
It could. Yeah, I mean, it would likely fail our due diligence, and we have funds where we've said no to. We've said no to some of our primary high conviction GPs based on some due diligence or based on some underwriting that we've done internally.
Speaking of private equity, there was talk several years ago that CalPERS, which has a large, not large by CalPERS standards, but large by other pension funds and other institutional investors, a large private equity portfolio, that you were interested in outsourcing it to maybe BlackRock or somebody else, putting that out for bids. It didn't ultimately happen. Why didn't it happen, and could it happen?
Well, I think that it was a fairly new structure that was highly misunderstood. Some of it would have, they were called the pillars of private equity, and some of that would have been, outsourced over to, say, like a BlackRock, although there were more than, BlackRock certainly bidding on it. But part of it was a reflection of the fact that we're in Sacramento trying to get high talent, high skill set private equity investors to move to Sacramento and then take the compensation that we offer at CalPERS. That was one of our challenges. And I think we fixed some of those structural issues. Our board just approved it.
Did you move from Sacramento?
We have not moved from Sacramento, but we've improved some of the compensation structures that the board just approved it last month. And so, we may open other offices if we believe we, would better, be served with boots on the
So you
ground.
could really follow the model that we've seen from some public pensions in other countries that, have opened an office, say, in San Francisco. You could see there being a CalPERS office in wherever. Actually, where? Where would there be a CalPERS office?
I could see one in San Francisco, as an example, to help with talent acquisition.
But that's within the state that you guys, could
New York, Asia, somewhere.
Yeah. How is that something that's truly on the board, that you guys are looking at real estate and looking at people?
Yes.
It's interesting. I wondered, the other piece of that is CalPERS a long time ago during the dot-com boom had a large venture capital fund portfolio. Didn't do very well, and then it did very badly actually, and then ultimately basically stopped investing in venture altogether. In part also because there was an argument to be made that CalPERS needed these large minimum check sizes, and most venture funds, if you were raising a $200 million venture fund, it didn't make sense.
Yep.
You've made some small entrees back in, mostly through fund of funds. Does CalPERS want to be back in actual venture capital?
No, we are back in it. We're very selective, and part of being selective is making sure that we have the right people making those selections. And so we've closed on venture deals. We like late stage venture, of course, but frankly, we missed out on all of the Silicon Valley growth. We missed out on that entire time frame. Whereas our peers really were able to take advantage of the great returns that came out of our own backyard, and we missed out. So we have to look at those opportunities. And again, back to everything is on the table right now. We have a new CIO.
Can I ask though quickly?
Yeah.
Do you worry you've come in too late? In other words, CalPERS came in a little bit late originally and paid the price, then it left. When it was gone, that's when the good returns were made. Now you're coming back in, and this might be another time when you're now coming in when the returns are about to be bad again.
Well, here's the problem. You can't be shy about entry, right? So you have to enter and stay, and enter and deal with all of the market turmoil that may happen. What happened in private equity as well as venture, people got shy, lost some courage, exited at exactly the wrong time, or did not keep the capital pacing. Right, so consistent capital pacing, really important both to private equity but as well as to VC. And we have this chart that we're showing where we were completely out of the private equity markets for about 15 years, and then the impact that had on returns.
One of the last things, just about kind of programs, things you're doing. There was also talk, almost around the same time as the BlackRock and outsourcing, the CalPERS, that you wanted to launch a kind of a direct investing program, kind of very similar to what we've seen from some of the Canadian pension funds. I think, Nicole, you made a comment that it's kind of a 10-year process if you're going to do this, or maybe you said it. Are you starting that? Because if it's a 10-year process, it's a 10-year process.
Right. No, we are starting it. I think, we're getting ready to share with the board the 2030 plan for the investment office, and we're seeing, a little quickened pace on the types of direct opportunities that may be coming into CalPERS. You look at the type of talent that Nicole, she did come out of the Canadian plans, that she's been able to acquire since her time here. She's about 1 year into the job. And you can see the direction of CalPERS. If you look at the talent, you look at the team we're hiring, you can see the direction we're taking.
So, could we see CalPERS become the majority owner of a company? CalPERS buys Company X? That's coming soon?
Soon might be
Time,
relative,
are we talking a year, 2 years, 3 years?
I would say within the next 2 to 3 years.
Next 2 to 3 years. I'm wondering, how do you think that there's been a bunch of talk, and we've kind of been waiting, that the White House that Biden is at some point going to have an executive order which limits U.S. outbound investment into certain Chinese sorts of companies, sorts of technologies. This could also impact funds. CalPERS has investments in a bunch of funds, Sequoia China Fund, for example. Do you believe that, at least the way we know the broad strokes of this, it would block, for example, investments in AI, certain chip making, et cetera? Is that a good policy?
I think it's always challenging to count China out, especially if you're thinking about growth on a portfolio that is expecting to get 6.8. We put in an emerging market debt strategy. We did not put China in that strategy at the time. So we're pretty underweight China relative to our peers. But remember, it wasn't that long ago that we had our chief investment officer at the time, who actually was born in China, went through a very difficult attack on allegations that he was misdirecting funds, which was completely nonsense. But that took a real toll on that individual. So China will always be a political issue. But from an investment standpoint, it's hard to discount China.
But so I'm wondering though, do you hear what's possibly coming and think that, we're about to have to divest a bunch of, if this order comes down, we have a bunch of stuff that's probably going to be in violation of this order?
We don't have a bunch of stuff. Like I said,
you have some stuff?
We have some stuff. We're underweight. We think that exiting that would not be a problem for CalPERS if that ended up being the federal requirement. But when this happened, 4 or 5 years ago, China was not put on OFAC, and that's what the investors follow. So foreign asset control, we follow every regulation, every rule therefore. But we're underweight. I don't think it would be difficult if we had to exit. But supply chain issues, I think you have to really evaluate what the supply chain disruptions would be if you count China out.
You talked about how fulfilling the fiduciary duty to the pensioners is your primary job, and you guys are 71% right now funded. Do you feel your job is more financial or more political?
Depends on the day. It really is a combination of the two. You're absolutely right. Political in the sense that you want to put up a really good, I think part of my job is, I call it boundary patrol, right? So putting up a good front around information and communication and context and accessibility to the decisions that we're making and why we're making them. And then the financial side is really, that's with Nicole, that's with the team, but really understanding what we're doing on the investing and whether we're going to get that value from the value creation. So I would say, it's probably 60, 70% political.
Final question for you. You came from Washington State Investment Board. Obviously, in terms of size, smaller than CalPERS was. But leaving the dollars aside, what was the biggest difference between doing a similar job, not CIO, but a similar job at WSIB to CalPERS?
Yeah, so I was the chair of the board at Washington State Investment Board. And, I think the difference is there is a complete alignment of interest with the trustees on that board around the importance of private equity as the primary, I think. They had 30% of the portfolio was in private equity, and they had been in private equity from 1981, 1982, right at the inception of, of that asset class. Whereas CalPERS has had its stops and starts, and there's been a real cost and a price to those stops and starts. So I think there's just been a more aligned culture and value set when I was at the Washington State Investment Board, and then CalPERS being the largest. We want our voice to matter. The Washington State Investment Board, their voice matters, but their voice mattered as an investor, not someone trying to change the world dynamic.
Marcy, thank you so much for coming down from Sacramento.
Yeah, thank you.
Don't go too far. We'll take a short break and be right back with more BFD programming. Axios BFD San Francisco is about to get started. Axios BFD will resume in 5 minutes. take your seats. The show will start in 60 seconds. Welcoming back to the stage, Axios business editor Dan Primack.
Hello, everyone. Just so you know, I'm not going to be the only person up here. My colleagues, Aaron Broadwin and Kia Kokliacheva and Hope King will be doing this. But I have one more right now. So I would like to welcome to the stage the CEO of TPG, John Winkelried. John? So John Collison, John was up here a little while ago, and he talked briefly about why his company's maybe never, ever going public and doesn't want to. You took TPG public last year. Let's see, Stripe is 13 years old. TPG was a scant 30 years old. You were also Goldman, albeit not CEO, when it went public. I'm curious, what experience, if at all, from being there at Goldman when it went public and then all the companies you worked with going public, did you take into either a thing to emulate or a thing to avoid?
Yeah, well, there were a lot of actual learnings from that I took into the process with TPG. One of the things that when Goldman went public, I was there. I was on the management committee of the firm, so I was close to the process, but I wasn't, obviously in the CEO seat. So it was a different, it's different, whole different experience. But one of the things that was clear is that we had a lot of clarity with respect to why we were going public when we were at Goldman, but also importantly, communication. We found culture and communication was super important because you're transitioning a firm that had a strong private partnership culture into a public firm, and the culture was very important to the organization. So communicating and encouraging people to talk about what were they worried about. The transition from private to public is a pretty big transition. So what were people concerned about? What are the kinds of things they wanted to really retain within the culture? Clarity on why we're doing it. Communication to customers, clients, very important in terms of why we were doing what we were doing. At TPG, I think the firm, as you point out, was about 30 years old, and we were transitioning. We were going through the process of transitioning from a founder-led, founder-governed organization, a firm that's been very successful over the course of 30 years, but now thinking about how do we transition that process to the next 30 years, because founders aren't going to be around forever. So you want a thoughtful transition. And one of the things that's really important is that a broad cross-section of people in the firm are stakeholders in the firm. And one of the things that going public allowed us to do is it allowed us to transition ownership of the firm. So there's a very high proportion of the ownership of the firm that's actually owned by insiders, besides the public owning about 20% of the company. And the process of doing that, we evaluated different ways of going through that process. The process of doing that was something that was probably most efficient by taking the firm public, as well as, our business, if you've been kind of watching it, our business is certainly going through a process where size matters in our business. There's a consolidation generally going on across the private equity landscape, across the alts landscape. And so access to capital was very important, making sure that you were creating both opportunities for our LPs in terms of new strategies, new opportunities to invest, but also creating opportunities for people inside the firm. Continuing to attract and retain the best people requires you to the organization to feel like it's got momentum, like you're front-footed, you're going to grow. And so the process of going through that was, again, communication with our teams, why we're doing it, what we're trying to preserve from a structure, from a cultural perspective in the organization. So all of the in that respect, there was a lot of commonalities between the two processes.
The other thing Carlson said was that Q1 of 23 would be a bad time to go public. Q1 of 22 looked okay, not great.
It looked okay until the day of our IPO, and then the day after,
right,
probably would have not gone public.
Right. So actually, I'm curious. I mean, do you, from a time, I guess kind of, do you regret going public when you went public? The stock's obviously lower than the IPO price.
No, I think we felt actually quite fortunate that we were able to get in under the wire. I mean, it was close. It was really close. I mean, if you go back and study what was happening to the market that day, I mean, the markets were basically coming under a lot of pressure. We were trying to go public, Dan, in December. And what happened is, if you remember, in December of 21, there were a number of new tax provisions that were floated in Washington, which created some complexity for partnerships. And so we were in a position where we were going to either have to potentially change our structure a little bit to adapt to that, or wait. And so we basically took the approach we were going to wait. And so we got ourselves essentially prepared in December. We did what they called our testing the waters meetings with investors. And then we had planned immediately when we came back in January, we obviously at that point had clarity that, these things the tax laws had not changed. And so we had clarity, and basically first day back, we started a roadshow, and we got it done.
So TPG is primarily known as a private equity firm. I know you have some other business lines, but primarily a private equity firm. And I was at the Milken conference down in LA last week. Almost every private equity conversation became a private debt conversation. Because private credit has become kind of such a part of the capital structures in buyouts. TPG, you guys used to have an affiliate, which was Sixth Street, which was largely a credit firm that was part in-house. It spun out several years ago. Most of your peers have private credit arms. Will TPG have one, and are you going to grow that, or are you going to buy it?
Well, we've said very publicly that we want to be back in the private credit business. I mean, there are a lot of reasons for that. I mean, it's becoming a very important part of the alts market. It's a very important part of the private capital market in terms of provision of capital, provision of credit. And if you look at what's happening with banks, a lot happening lately too. There's been a steady going back over the last decade. There's been a steady reduction in the provision of credit out of banks to the private part of the market. And then there's a lot of opportunities right now. In particular, look at the markets right now with the dislocation in valuations. One of the things that's happening is there are really interesting opportunities. We're typically, as a private equity firm, obviously we're typically in the equity part of the cap structure. But if you look up and down the cap structure from a risk-return perspective, there's some pretty interesting areas. So we're definitely committed on getting back there and having a robust business. There are different ways of doing it in terms of either trying to start it organically or trying to acquire a business. We're open-minded.
There are some for sale.
We'll have to talk. Yeah. But we're open-minded in terms of considering either way at it, so we're focused on it.
You're focused on it. I'm wondering, there's some talk that the leverage loan, and again, since you used to be Goldman, there's some talk the leverage loan side of the business is starting to make not a comeback, but it's starting to make inroads again as they drop pricing. Are you seeing that?
You mean from banks?
Yeah, from banks.
I think that the broader trend is that you will see banks play less of a role in the leverage loan market and buyout financing. I think that's the trend, and I don't think the trend is reversing. What you tend to see from the banks, particularly the largest banks, is sort of a little bit of a cycle to their appetite to lend. So, if you look back to last year, when a lot of the big banks had a lot of unsold or inventory from leveraged loan transactions and buyout financing that were unsyndicated, they took fairly substantial losses on it. I mean, you see, from my experience in banking, you tend to see sort of this kind of feast or famine mentality with respect to their desire to take risk in that part of the market. And clearly we're on the backside of sort of, we got burned, we're trying to be more careful. The market was almost closed the broadly syndicated loan market, which is what's sort of referred to as kind of the, within the leveraged loan market, was almost closed from a banking perspective for, the better part of the second half of last year. It's starting back to open back up again. But again, if you look at where if you look at where the lending is now coming from, you either have private equity firms going direct in some cases to LPs of their own that want to finance buyouts. You have direct lenders that are all private sources of capital that are large players now and have accumulated large pools of capital. So they're a material part of the market. And then obviously you have the banks. So
guys, the other thing you have, and this was on the bank side, and this is interesting because I think this is a process you guys are in, which is, I think it was JPM, it did a staple financing or has offered a staple financing for Subway, the not that good sandwich chain. And and I haven't seen one of those in a big buyout for a while, or a big potential buyout for a while. Do you think that's a one-off, or do you think we're about to see a return to that, so that when you guys maybe have interest, you don't have to worry about the financing?
I think you'll see staples on and off depending on the asset. I think that there's sort of I think it depends a lot on the asset. I think to the extent that that people view the asset as a strong company with that'll experience maybe less volatility through the cycle in terms of economic cycles, I think you'll see more of a willingness for people to put staples alongside of assets for sale. But I think it's going to be kind of episodic.
Yeah, there's talk, and I wrote about this the other day, that when you've got rising rates and you've got potentially slowing economic growth, that one of the things that could obviously happen out of that, at least on paper, from a kind of a pure economic standpoint, for a private equity portfolio is bankruptcies. Do you expect to see, whether it be a TPG or in general, a lot of portfolio bankruptcies, or is this once again kind of like it was in 2009, where Cov Light comes and saves the day for everybody?
I think probably fewer bankruptcies than people expect. Again, because of the flexibility within covenant structures, the ability to kick the can down the road in a number of these situations. I think it also depends on what happens to the economy. I mean,
speaking of which, does what's happening right now with debt ceiling, does it scare you or no?
Yes, in a way, yes.
What way?
I think that we've gone through this cycle a couple of times. And I think the assumption has always been who would possibly allow the U.S. government, our government, to default. It seems insane in a lot of respects. And I think that the political process has gotten increasingly heated, in some respects maybe even slightly less rational because of the polarization. And I worry that maybe there is perhaps more of a willingness to go to the brink. And so I'm a little more concerned than I might have been otherwise. Like last time, I think last time we sort of were in this brinkmanship was like a decade.
2011.
Right? Yeah.
I'm just curious. I mean, you've been in the financial markets for a very long time. Can you get your mind around what a default would actually mean in practice? You default on a Monday, what actually happens to the stock markets, to the bond markets, to your own companies?
Honestly, I think that it's, the answer is sort of, yes and no, okay? I mean, I think that we'll probably get downgraded as a result of a default. I mean, kind of definitionally, you get downgraded.
We got downgraded in 11 without the default.
We did. Yeah. And so definitionally, you kind of get downgraded when you default, but the long-term implications of how people perceive our creditworthiness, the reserve dynamics around our currency and how that might be affected. This process this time versus 2011 is one very important fundamental difference, which is that 2011 was a credit easing period and a quantitative easing period. So there was a lot of liquidity that was getting sucked up by the Fed's balance sheet in terms of buying securities, taking securities on the balance sheet, generally accommodative credit, and also very low interest rates. So sort of changes in interest rates as a result of cost of debt were not that profound in terms of debt service.
So you think a downgrade would be a bigger deal or a bigger problem in 23 than it was in 11?
I do, yeah, I do.
I want to go back to one of the other things Carlos and I briefly talked about was AI, and I'm curious your thoughts here. You started your career as an intern at Goldman Sachs, and private equity and investment banking, I guess, but private equity is viewed as this apprenticeship business where hopefully people come in and they do modeling and get some coffee for people, et cetera, and eventually hopefully work their way up to your position. Do you foresee Goldman Sachs or TPG needing interns or analysts in 2 or 3 years? Are those jobs going to be there?
100%.
To do what?
I think that, there are a lot of issues there.
Yeah.
Right? We don't have enough time, I think, but there's a lot of issues there. I think that AI obviously is kind of washing over everything right now. And, in some respects, it reminds me of other periods in time where, everything was kind of cloaked in, like it was when the internet was created and everybody was talking about sort of, access to information and that was sort of washing over everything. Or back with, broadband and, when everybody was thinking about like, everything.
You don't think it's more transformational than this?
Well, no.
Potentially.
I think potentially look, the answer is yes, but I think we're far from, analysts and interns working on trying to identify interesting companies, trying to do basic, do modeling work, evaluate, help with diligence around, fundamental diligence around companies that you might be investing in. AI may be a tool that helps that process, but there's still a lot of creative intellectual energy that is spent and exercises around these issues. And so I have no doubt that there will be interns and analysts and associates at private equity firms and banks in whatever that time frame was you just said.
Whatever it was time frame I said. Let me ask about something totally different, because we have 5 minutes left, which is TPG Next. What is it?
It is a seeding and stake strategy to help diverse managers get into business. What we saw at TPG was an opportunity to use our expertise in how to run an investment firm, a private equity firm, how to build a GP, how to firm build, and also how to invest, and extend that expertise to diverse people that want to be in what I think of as the capital allocator seat. Because one of the problems when you talk about not enough capital flowing to diverse-led companies is you don't have enough diverse-led capital allocators, because the networks they have, the people that they know, who you call, where you're likely to connect with somebody to understand what they're doing and how they're building a business. It's very hard for people who are. It's very it's very hard for necessarily a white male, to have the same kind of connectivity to a broad set of diverse people that are trying to build companies than it is for someone who's also diverse.
Can I ask about that? Yeah. How do you apply that to TPG itself? Because, and this is just based on the website, if you just look at gender, for example, only two of your 9 members of the management committee are women. Only 30% of your board of directors. If it's a good business for others and for you guys to invest in, why not apply it in-house?
Well, we're obviously trying to apply it to ourselves because, we have undertaken a bunch of initiatives internally in our own firm to try to make our firm more diverse. It takes some time in terms of the life cycle of somebody in the investing role. What we've done, though, for instance, on the boards of all of our companies, we undertook a board diversity initiative in 2017. We've put 400 diverse people on the boards of all the companies we either control or have significant influence on. So we've changed the makeup of the governance dynamic and the inputs that those companies are getting. And when you look at the TPG Next initiative, not only do we think that it's a smart thing to do, it's a good thing to do, but what it's doing is that it's expanding our network. It's expanding the flywheel of opportunities that we see because otherwise we don't see those opportunities necessarily. So I think it's a really, I think it's a really interesting initiative. It's kind of one of a kind in the market right now. And since we've announced it, we've had approximately 400 inquiries from various people in the market who are diverse that are interested in either building their own firm or getting into business to do deals as a fundless sponsor, at least for a period of time until they can build their own firm. And I mean, just that network itself alone and the opportunities that we're seeing come into our firm as a result of it, the process of changing the culture of our own organization is also about getting our own team and our own firm engaged in actually helping some of these managers. And that changes the culture fundamentally.
Final question for you is about part of your business, which is growth equity investing. TPG, which again, the history was, a leveraged buyout firm. You guys got big into growth equity investing. Obviously had a big investor in Uber, unfortunately a big investor in Vice, and a few others. I wonder, there was a period of time, a pretty long period of time, where it really seemed like shooting fish in a barrel. Throw money anywhere and the money was going to come back and the valuations were going to go up. Things have obviously changed a lot. How differently now do you feel your team is analyzing those opportunities than they were a couple of years ago? And does it make sense to keep investing as much in that space?
Yeah. Well, first of all, I think it's important to put a point on the fact that our growth equity business was very different than a number of other growth equity businesses. I would not describe our business as sort of what I call kind of venture growth. We did invest in Uber. We did invest in Airbnb. By the way,
felt like venture growth.
That was, you're right, but I think we had a unique window on it because we were in this community here. We're located in San Francisco, and one of the unique aspects of what happened as an example, just as an example with Uber, is part of the reason that they wanted us to be an investor in the company is they felt that we could help them globalize the business because we were familiar with other markets and we were in other markets. So they felt we were kind of in a unique position to kind of join the board, which we did. But if you look at the mix of our business and the growth equity, in our growth equity business, we do as much controlled buyout, mid-market controlled buyout business as we do minority kind of pref equity investing. And if you look at the diversity of our exposures, we're very, healthcare is a big sector for us. Software and enterprise technology is a big sector for us. What we call internet digital media, which would be an Uber or an Airbnb investment, is also a big sector for us. But it's different than what you might find from other sort of venture growth funds in the market because of the nature of the diversification of the types of investing we're doing. So anyway, I think, it's definitely not shooting fish in the barrel. That's for sure. It's hard no matter what. But I think we feel like, if you look at the consistency of returns in our business, as opposed to the vol of the returns of some of the venture growth businesses, it's a very different profile.
John, one word answer because it says zero and there's people in my ear. Does the U.S. go into a recession in 2023?
No.
Thanks for joining us. Be great.
Put your hands together for our next moderator, Axios technology and business reporter, Kia Kokolacheva.
Hello. This is so exciting to have you guys here. As a San Francisco resident, this is like such a treat for me. So thank you for being here. Our next guest is one of the most recognizable names on Wall Street, and she makes bold bets on innovation. So please welcome the founder, CEO, and CIO of ARK Invest, Cathie Wood. Thank you so much. All right. Well, welcome to San Francisco, Cathie.
Thank you. I'm really happy to be here.
Joining us from the East Coast. We're just going to jump right in. I know that you invested through your venture fund into the Elon Musk-owned Twitter.
Yes.
How do you think he's doing running the company so far?
It's very interesting. We knew, and we got in at that the then price, and then of course they price the options. And this is our foray into venture. So it's a public-private crossover fund. We're democratizing venture capital, and for $500, anyone can participate. We're not taking a carry, so no accredited investor limitations. So we're pretty excited about it, and we're looking to buy more Twitter here.
So you like how he's doing?
We are so excited by what he's doing. Now, regardless of your political leanings, when someone like Tucker Carlson leaves or is fired from Fox and says, I'm putting the show on Twitter, which just happened, something is changing in the media world. And I do believe Elon's push towards an everything app a la WeChat Pay, he did start in the payments industry. I think he's going to be successful.
But there's been reports that revenue is down, I think as much as by like 40% in December. Does that not concern you, or do you know something about the company that we don't?
No, no, I don't. I promise I don't. Everybody thinks I talk to Elon every day. I don't. He'll often, bless one of my tweets, but we really don't talk. I think that the old model wasn't working. It was an unworkable model. And we had pulled away from it. They just weren't able to monetize. And I think he is going to be able to monetize. Sure, there was a shock value of Elon Musk and, his unceremonious, firing of people. But they are turning cash flow positive. I think their advertising is now picking up again. So from a new base, but they've fired 80% of the people. And you know what? I'm a big user of Twitter. It has not skipped a beat.
Well, except for the service being down here and there, but okay. Okay, so your theory is that it's going to get worse before it gets better, and it's going to get better.
Oh, I think it will get better.
Okay. You're also an investor in Elon through Tesla, longtime Tesla investor.
Yes.
Does it bother you that he's spending so much time on Twitter, on top of all his other non-Tesla jobs that he already has?
I think he surrounded himself by brilliant people at Tesla and at SpaceX and his other companies. I think he's our Renaissance man. He is the inventor of our age. And he's got an enormous capacity to take on new projects. I do think Tesla, the most important project, and we think it's the most impactful AI project out there at Tesla, the autonomous project. I don't know if many of you probably do have Teslas. Many people in the investment community clearly don't, because they don't understand what this last software upgrade did for full self-driving. I mean, I think they're almost there. And we think that opportunity, so he's almost there, we needed him to push and get us there, just like we needed him to push on the EV side and get us there. But he's almost there, and I do think he has time to devote to Twitter. And I think, you know what? If he's happy, I'm happy. He's excited. He's excited, which is fantastic.
I'm going to ask you about autopilot in a second, but you mentioned that he surrounds himself with really smart people at his other companies. He hasn't gotten a CEO for Twitter yet. Do you expect him to? Do you want him to?
I think he wanted to clean house first and become more transparent, certainly make the algorithms more transparent and help people understand, what is allowed and not allowed, as opposed to, random censoring. So I think he's on a mission there, and I think it's a good mission.
He's definitely learning about content moderation, that's for sure. So CEO coming eventually?
He says he wants to bring in a CEO, and I think he really loves bringing the physical and the digital world together. This is less that, however exciting it may be, but I think that he will bring in a CEO.
So back to autopilot. So I know the TSA regulators are investigating autopilot. Possibility could be even taking it off the road, doing a recall. As an investor, does that concern you? I mean, autopilot is basically the Tesla promise. It's the magic. It's the vision. How monumentally bad would that be? Are you concerned?
No, we're not. So first, I want to give all credit to our analysts, Tasha Keeney, Sam Corris, and Daniel McGuire, who just joined us. And they have put together our new Tesla model, the updated Tesla model, which has gotten some publicity. The target price for 2027 now is $2,400, and we're at $170. And most of that, a good part of that, is autopilot. In Tesla's Investor Day, which Tasha and Sam attended, we learned, they brought out data, disclosed data, which showed that a Tesla car with full self-driving is 6 times safer than the average car on the road. It has one accident every 3.2 million miles, whereas the average car has one accident every 500,000 miles. If you were to compare the new Tesla FSD with those, the ones that didn't have that or don't have that capability, it's 6 times safer than the average car, 5 times safer than the old Tesla cars. Now, if there's one thing the National Highway and Safety Transportation Association, NHTSA, needs to pay attention to, it is fatalities. We've had decades of fatalities in autos coming down since the safety driving measures, safety belts and so forth, started upon the scene in the 70s. It went down I'm not sure where the peak was, but it was at least double where it is now. It dropped to 35,000 around the time we started ARC, and to 30,000, and now it's back to 45,000. That is just in the last 8 years. Why is it? It's because of texting and cell phones and so forth. That is their mission. They need to make the roads safer. And one thing I know, every time they examine a fatality, why don't they examine all the other fatalities out there on the road, the ones that kill 45,000 people a year? You only hear about Teslas. It's kind of crazy. But anyway, when they examine those fatalities, most of the time, the majority of the time, they conclude that it is the driver's fault. There's so much monitoring, so many sensors within the car. And they come up with yet another metric that says, you know what? Tesla cars are safer than most cars out there.
But people have gotten into crashes while on autopilot because they're doing other things and not paying attention.
Well, they're supposed to be. If you've used autopilot, you know you have to be paying attention. You have to, and they tell you you have to. It is this last upgrade. I'm glad they beep at you and just make you put your hands on the wheel and keep focused. This last upgrade is pretty astonishing, though.
Fair enough. All right. Still a big Tesla believer. Yep. Let's talk about Coinbase. That's another company you're invested in. Last week, the company had its quarterly earnings. They were surprisingly good. And you guys actually loaded up on some more shares right before the earnings. Lucky bet or...
There is so much fear out there. In our world, the public equity world, if you say the word regulators, as you did with Tesla, right? A lot of investors they run. They don't want to deal with this. It's usually not good news. In this case, it's been very interesting. Every step of the way recently, the SEC has been saying one thing, and the Justice Department is coming out and saying, wait a minute, what is going on? Or the court system is coming, like, what are you doing? The Grayscale case, why The basic question Grayscale poses is, wait a minute, SEC, you approved a Bitcoin futures ETF, which involves swaps, which involves counterparty risk, right? In a time when we should all be concerned about counterparty risk. And you are denying Grayscale, we've got an application, you are denying a Bitcoin ETF, no swaps risk. In the case of Grayscale, all of that Bitcoin backing the GBTC is at Coinbase in cold storage, 1 for 1. Okay, what is the logic there? I think they're going to lose that case. It looks like they're going to lose the Ripple case. It looks like they did lose the Voyager Binance case. The courts are saying, what are you doing? You don't have jurisdiction to do this. And so I think our checks and balances in this country are going to work. It is unfortunate that companies like Coinbase, they're setting up an exchange in Bermuda. Galaxy said yesterday it's going to move some of its services offshore. It's becoming clear regulators are doing something that in the early days of studying this, because we bought our first position in GBTC in 2015, in the early days, I was all over, okay, what are the regulators going to do? And I met with state regulators, federal regulators, and one thing I learned back then is no regulator wants to be blamed for chasing innovation away from the United States. Well, Gary Gensler has changed that, and I do think this is going to become an election issue. The Financial Services Committee has a subcommittee called the Digital Assets Committee. It's meeting now, and I really do think that Gary Gensler, he's going to lose one way or the other, and if we do get another administration, he'll be out.
So Coinbase is very openly pushing back on the SEC. So you are supportive of them taking those aggressive stances?
Absolutely.
The company also announced and then basically walked back sort of the idea of leaving the U.S. How do you interpret that? Should it leave the U.S.? Do you think it's more of a bargaining kind of tactic?
No, they're actually setting up in Bermuda a derivatives exchange, which they do not have here. And they've said they don't want to leave the United States, but at the margin, the incremental dollar in their business will move abroad unless something changes. And I like the checks and balances. I like that the court system is weighing in here. This is, this can be very messy in our country, but as Winston Churchill says, once we've made all of the mistakes we can, we usually get it right.
Shifting gears a little bit, so you mentioned your venture fund earlier, which regular retail investors can participate in, no need to be an accredited investor, to let people invest in private tech companies. Why is this a good idea?
Oh, it's a wonderful idea. Why isn't it a good idea? No, seriously, it's the question I get very often when we're going out, especially from young people who can't meet the income and asset thresholds, and yet know these companies that venture capital is, that venture capital is putting into their funds, and just want to be a part of it. They see, they know more about the technology probably than a lot of people in the venture capital space. And so it's really un-American, I think. I mean, it would be like, okay, if you meet this asset and income threshold, then you can get a driver's license and drive. I mean, I do believe the premise of the way you're asking the question, Kia, is this isn't safe for them. Okay, well, it is very risky. Early stage is much riskier than having IPO'd. So yes, have someone manage it for you and with you, but come on the journey with us for just $500. And so we're trying to do in venture capital, partnering, by the way, with other venture capital firms. They've been very kind to us, and I think our research is our calling card. I think a lot of companies, startups out there, know that the research we're doing is really good research, and we have a shopping list. We know what we want in terms of the companies we see in the 5 major areas around which we've centered our research. So multi-omic sequencing, robotics, energy storage, artificial intelligence, and blockchain technology. We have a wish list, and we are going to those companies. And very often they're already involved with venture companies. But because of the respect for our research on both sides, I would say, and because we are going to increase the visibility of these companies, we are distributing, so we have a social distribution strategy, part of the democratization, an Andreessen Horowitz funded company, Titan. We were are the first equity product on that platform. And I can't tell you how thrilled I am to see, in the midst of the banking crisis, day to day, every day we've gotten inflows. Are they huge? No, it's 20, 30, 100,000.
How big is the fund now?
It's in the $15 to $20 million range. So fledgling, but we just started it.
Do you have a target? Like, what were you thinking?
If we're right on how these 5 platforms are going to scale, I'll just bottom line it for you. We're talking about super exponential growth here. So we believe that in the public and private equity markets, truly disruptive innovation is valued at about $13 trillion today. So a little more than 10% of the total markets. We believe that number, and you can find this in our Big Ideas 2023, the building blocks for this. We believe that 13 trillion is going to scale at a 40% annualized rate to more than 200 trillion by 2030. And so, yes, we think that there's room for a lot more companies. We're going to need a lot more companies to help facilitate this growth. And a lot of companies are staying private for longer for regulatory and other reasons. So, we felt it was very important. We were already doing the research. We have to do research on private companies if we're focused on disruptive innovation. And it's such a joy now to not research just to research for our public companies, but to actually be in there and say, oh man, we can take this company from almost nothing to, please God, the moon. Can't make any promises, but our research says they are going to help make this happen, and we are discerning that way. We believe we know at least the technologies that are going to be necessary, and who's in the best position.
So I totally appreciate how much work you guys put into that, and you want to minimize sort of the risk, I guess, or the unknown. But that there's such a difference in the amount of information that publicly traded companies disclose versus what privately owned ones choose to disclose effectively. It's hard to believe that you can really achieve that same level. And part of the risk is exactly that, not knowing anything and listening to visions from founders. Does that not concern you?
No, I actually think we're in a really good position to do this kind of work, because even in the public markets, we get spoon-fed quarterly numbers, right? And you have this obsession or obsessive compulsive focus on those short-term numbers, most of which don't make any difference strategically. I mean, sure, there are report cards and there are certain things you want to see happening on the top line and maybe on the gross margin line, but you really want these companies, at least the companies we invest in, to invest aggressively now. So many of our public counterparts do not like our stocks. And in fact, most of our stocks are not in the broad-based benchmarks. because we have a 5-year investment time horizon. We're willing to buy companies that are not earning money right now. We love their gross margin structures. We love the revenue dynamics. We love their positioning in the marketplace. But they're spending aggressively. That's what we want them to do. And that's what the best venture capital funds encourage them to do, wisely, but aggressively, if they're onto something big. So we're already doing that. That is what we do already. And that's why we're considered such a different duck in the public equity markets. Nobody really understands what we're doing, but effectively it is what venture capital does. So we're widening our lens here.
We're out of time, so I'm going to ask you one last yes or no question. Is AI going to take your job?
I don't think so.
Okay. Well, thank you so much, Kathy, and we're going to take a very, very quick break.
Thank you. Thank you so much. Thank you. Thank you. Dr. Want to go first? I'll follow.
Don't go too far. We'll take a short break and be right back with more BFD programming. Axios BFD will resume in 5 minutes. Please take your seats. The show will start in 60 seconds. welcoming back to the stage Axios business editor Dan Primack.
Hello, everyone. Before we get to our next guest, I've been doing Axios Pro Rata for over 6 years now, and one of the most common emails I get from people is, how can we search for the deals which are in the newsletter outside of just going through Gmail and hopefully maybe sort of trying to find it? So I want to take a quick moment to showcase our new Axios Pro Deal Tracker, which has been trained on all the data from Axios Pro Rata and from Axios Pro.
On January 9th, 2017, Dan Primack dropped this BFD in his first Axios newsletter. Since then, we've covered a lot of deals, over 10,000. M&A deals, VC deals, private equity deals, growth capital, IPOs, and more. If you work in deal making, you know it can be a lot to keep track of. That's why now we're launching Deals Tracker, a new feature exclusively for Axios Pro. Deals Tracker uses AI to read and consolidate our coverage, giving you the information you need about the deals that matter to you. Here's how it works. Every deal we've reported on has been added to a new searchable archive, and every deal we cover in the future will be added too. The Deals Tracker gives you quick access to deal history for companies and investors across a variety of industries. You can easily narrow your research, focusing on the things that you care about. The tool lets you easily see different deal types to understand who's raising money, who's buying or selling, who's merging, or big personnel moves. The search results are concise and easy to read, giving you the most important information in seconds. But if you need to dig deeper, you'll be able to download deal data or explore our in-depth reporting, giving you context to why deals happened. When you combine the utility of the Deals Tracker with the analysis and expertise from our industry-leading journalists, Axios Pro now offers the most helpful toolkit available to the modern dealmaker. The Axios Pro Deals Tracker beta will be available to all current Axios Pro Deal subscribers starting in Q2 2023. Scan the QR code on your screen now to join the waitlist and receive product updates, special offers, and previews of our best reporting.
All right. Let's get back to it. I would like to welcome our next guest, who is an entrepreneur, an engineer, and also the owner and chairman of the Sacramento Kings basketball team, Vivek Ranadive. Thank you. All right, so this is not anywhere in my questions, but you got to tell me about the jacket.
It's pretty cool, isn't it?
It's very cool. Tell me about it. I see there's a patch. I don't know what's on it.
Yeah, well, it's got the Kings.
Oh, I'm sorry. That's Kings on that side. Okay.
Yeah, well, I was at the All-Star game a year ago in Cleveland, and there was this guy sitting next to me. He was wearing this cool jacket. And I said, hey, that's a cool jacket. And he just took it off and gave it to me. And he's a famous designer. He made the NBA 75-year jackets. And so I said, hey, this is a cool opportunity. So why don't you design one for me and the Kings? And I think we sold them out, we charged $1,000 a jacket, and we sold them out in a minute.
So let me ask what's maybe an uncomfortable question. There's obviously a basketball game going on down the street tonight. You used to be part owner of the Golden State Warriors before you sold that so that you could buy the Kings.
Yeah.
The Warriors obviously were the ones who knocked out your team. But you also live in Atherton. So who do you root for tonight?
I just want both of them to lose.
Is that something new? I mean, you're on the board of governors, right? Can you make that work?
Well, what's crazy is I've been on the competition committee, and I'm a guy who grew up in Bombay. We played cricket and soccer. And I'm sitting between Michael Jordan and Chris Paul making up the rules of the game. What a great country.
I'll ask one other question about this game. So you want them both to lose. Who do you think is going to win tonight? Just tonight.
Well, I think the bookies are saying that the Warriors are going to win.
So you go with the bookies?
I think...
Is that an official NBA position, go with the bookies?
Well, no. But I think it's going to be a close game.
So you bought the Kings in 2013, and since then there's been 7 other NBA clubs that have changed hands, which is a lot.
Right.
Why do you think, it seemed to used to be in pro sports, the teams almost became family businesses and were passed down almost from generation to generation. What is driving, from your perspective, this boom in pro sports teams getting sold, not just in the NBA, but you're seeing in the Premier League and the NFL, et cetera?
Yeah, so a lot of these people bought teams for millions of dollars, and these teams are now worth billions of dollars. And there aren't actually that many sales, and they usually, someone passes away or someone is forced to sell. Because it's really, really hard to own a team. And so once you own that team, you do hold on to it. But the values have just gone through the roof. So if you look at the NBA, the returns have been over 20% a year. It's grown faster than the S&P or any other index. And this is an amazing asset class. It's as safe as a T-bill, but it's got the upside of a growth stock.
Do you feel there's any particular reason? It's interesting. It feels that every time a team gets sold, I'm from Boston, right? So I think when the Celtics got sold, and this is now almost 20 years ago, and that price people kind of opened their eyes at. Ballmer buying the Clippers, and obviously what just happened with the Suns, rather. Yeah. Does it ever plateau? Is there a reason for it to plateau? Is there a factor that you'd be like, oh, these things aren't going to keep going up and to the right?
Yeah, so when I joined Joe, and he was the chairman of the vice chairman at the time, and we paid $450 for the Warriors, and the equity check was about $300, and people said that was crazy. And then later on, I paid $535 for the Kings, and when I did that, I said that no, these things are worth billions. So in 20 years, will I still be using my iPhone? I don't know, but will I still be watching NBA basketball? For sure.
Is the underlying business that much better today than it was 20 years ago? Or is it simply that there's just scarcity and more very wealthy folks?
I think it's both. So I think there's kind of a perfect storm. So on the one hand, the content value just keeps going up and up. So we're in the process of negotiating a new contract. And this is the only content that you're not going to time shift. You're going to watch it as it happens. And then you also have the games becoming more global, so that's kind of a second vector. And then finally, historically illiquid markets are now becoming more liquid, so we've opened the net, so pension funds and private equity and other people can now participate in ownership. So when you combine all those forces, the values are just going to keep going up.
Private equity funds in the NBA specifically are allowed to invest now, but they can only own minority stakes. You can't be a private equity fund cannot be a control owner of an NBA team. Should that be changed? Should private equity fund be allowed to be you?
I think that the way the NBA has it makes sense. I think that there's really two aspects. One is getting the appreciation and value, which is really what the funds want for their investors. But there's also the governance. And it's important to keep the governance tight because really at the end of the day, one person has to call the shots.
What are your thoughts? The NBA is now about to allow, or is going to allow, individual players, active players, to have ownership stakes, small, obviously, ownership stakes in teams. What are your thoughts about that? In particular, and I guess, and this is my own ignorance on trying to understand it, can one of your players buy a piece of the Warriors?
Yeah, I think, look, it's a great asset class, and so if people want to own, I actually tried to convince the league to let me keep my ownership in the Warriors. To
own both? To own a piece of both?
Yeah, and I said I'd keep it in a trust because
I'm
just very bullish.
Jacket.
No, it's just an economic thing. So obviously I would want to beat them every single time, but which we will. But I just think that it's a great asset class, and hey.
But I'm curious. I mean, could you foresee a player? Could you foresee Sabonis, for example, owning a piece of the New York Knicks or any other team that you guys might be playing against? And just like players can't, for example, bet on basketball, players can't play. Is there just an inherent conflict if that happens, or not?
I think right now people would look at it as a conflict, but even just the owners, like there's so much. When you sit in the room with the other 29 owners, many of them are running giant funds. And there's so much, there's literally $1 trillion of money in that room. Yeah. And so if you want to invest in some of the other teams, I think you should be able to, because I think it's a great asset class.
I'm curious, if you're a fan of an NBA team, say I'm a fan of the Kings or was a fan of the Kings and you buy it, or I'm a fan of the Celtics and somebody else buys it, random billionaire X, should I as a fan care a lot? In other words, does it really matter to me who owns the team, so long as they've actually got the money to buy the team and, invest in the players?
Yeah, I think that it should matter because you want somebody who's got a long-term commitment to winning, but also to the community and the city. It's a privilege to own a team, and increasingly it's a platform. So we've used it to do a lot of good in our community. And we invested like $1 billion into the downtown And that's created a 10x amplifying effect in terms of other investments that have come in. So when I look at it, we don't really own the team. The team is owned by the fans. It's owned by the city. It's owned by the media, and we're just like.
I'm not sure you would. I'm not sure the fans in Oakland would feel that way about their teams and what's happening right now.
And that's what, and the fans in Sacramento saved the team because Bama was going to move the team to Seattle, and they got together and they got on social media.
Can I ask, how do you feel? Am I right in saying that in the NBA, and we haven't had teams moving lately, but you have a vote in that, right? If a team is to move, what's your fundamental philosophy on if a team were to move, how you vote on that? Because obviously you are ripping the hearts out of millions of people when you do that. Yeah, so it's unfortunately I actually chair the committee where some of these things come up. It's like the worst committee. I don't know why I'm kind of the sucker they put in. What's it called? What's this committee called? It's called the planning committee. Planning committee? That seems. Yeah, you decide how to split the pie. And so if there's a market where it fundamentally just will never work, where the numbers will just never pencil out, then perhaps you need to look at where is there a better market. How much of owning a pros? Actually, let me ask. You also own a minor league baseball team, correct? That's correct. There's obviously a billion differences between the NBA and a minor league baseball team, but are there any lessons that are there lessons from the Kings you've learned you've been able to apply to the baseball team and vice versa? Yeah, so I'm just very bullish on sports, and I'm also very foolish because I paid the highest price for the Kings. We just paid like more than double the highest price for a AAA team. But it's really more than a team. It's a social network. It's data. And so when I look at it as an incredible business with great data, with a great social network, and the ability to monetize that in all kinds of ways. So I think there's many lessons that are. You made the comment about how you're not one of the things about live sports, I guess, in the NBA as part of this, is that people aren't going to time shift. So if the game's on at 7, they're going to watch the game at 7. Yeah. Since you bought the team, though, just in that relatively short period of time, consumption has obviously changed in terms of, not just in terms of where somebody watches a TV versus streaming, also in terms of people watching more highlights than games and stuff. Do you get a sense that fewer people are watching your entire games? And if so, how do you think about that from a monetization standpoint and also a product standpoint? Yeah, so in terms of the actual TV ratings, they have come down, but that's because we've gone from cords to cord cutters to cord nevers. But the actual consumption has gone up. So in the case of the NBA, our social media consumption and the metrics on social media are actually bigger than all the other leagues combined. So I think that we just have to cater to the way that people want to consume it. Can I ask about that? You mentioned that the rights deal's coming up. There's obviously a lot of things about regional sports networks, and you guys are a little different than that. But I guess kind of how do you think about broadcasting on local TV? Is the goal to make the most money or to reach the most people? Well, I think the goal is to cater to fans in the way that they want to be catered to. And I think if you do that and you do a good job with that, then you will make the most money. Adam Silver said at a conference recently, the NBA's got to kind of rethink the local model in terms of how games are broadcast locally. So I guess bluntly, is the regional sports network model broken? Obviously there's some of them that are in bankruptcy right now. So I think it's definitely challenged. But I think it also represents opportunity. How so? How would you fix it? Yeah, I think the way that you consume it you have to have options for how people can consume the content. And in the case of the NBA, we're very lucky because the demographic is a young demographic, and they might consume it differently than an older demographic might. And we just have to be flexible and cater to that. And also the loyalty has shifted, and so that's also kind of interesting, where you might have been loyal 50 years ago to like ABC, and then you might have been loyal to the NBA, and then you might have been loyal to a team, and now it's kind of you're loyal to a player. You want to watch Steph or you want to watch Fox. And so we just have to be flexible and let people consume it in the way that they want. I'll just jump this in here. Or you might want to watch Harrison Barnes. Do you want to re-sign him? Well, that's up to my GM, so that's beyond my pay grade. Okay. No, he's a good player. I love him. I hear that from owners. I leave that up to my GM, and I know you do, but do you? Yeah. Well, it's basically
they come to you with recommendations. And I think of myself as kind of the chief irritant, where I just will ask a lot of annoying questions.
I'm wondering, do you feel, you'll hear some pro sports owners talk about how, again, we let the sports people deal with the sports piece of it. I know what I don't know. I came to this as an engineer. Do you feel, though, that you now today know more about the actual product, the actual stuff that happens on the court than you used to, and that you are smarter about it, and that you could contribute more than you could have, say, 5 or 6 years ago?
Yeah, I got more involved about a year ago,
what drove that? Why did you get more involved?
Yeah, we had made some decisions, and they had not always been great, and I just wanted to make sure we got the right coach, and so I got involved in the coaching search and had like a 6-hour dinner at my house with Mike Brown, who we ended up with,
right,
and just kind of set the rules. And I said, look, I think it's going to be a little different, where we're going to have radical candor. We're just going to tell each other how we feel, but that's also going to be coupled with radical love, where there's always going to be love and support, and we can disagree, but after that we all speak with one voice. And so I spent a lot of time with him, which I hadn't done in the past, and we went to Europe together on a trip to watch Sabonis in Euro basketball. Spoke much more to the front office folks. And so I think we're in a great place where we all communicate. And
going back to how people consume, one of the ways that more and more fans are consuming sports and not watching it or interacting with it is by betting, and particularly betting off your phone. Not something that's able to be done by people in California right now.
Yeah.
Do you want that changed? Do you want mobile?
Definitely. I think the game about the game is going to be even bigger than the game.
How do you feel that you, and not just you, but Joe with the Warriors and Ballmer, do you feel financially that your team is at any disadvantage because there's not a hometown gambling aspect to it?
I think right now the numbers are small, but I think over time it'll start becoming a factor.
So you made your money in tech. You're not just the owner of the Kings. You also are a venture capitalist with Bo, your firm, and some of the members of Bo were in the back earlier. How do you split your time? How much of your time is investing outside of sports compared to the Kings and the baseball team?
Yeah, so I let my folks at the Kings do most of the. I've got a great team, and they do most of the work. So I spend more time just looking at investment opportunities. But I'm also looking at investing in sports teams, so that continues to be an area of interest. But we talk often, so I literally am speaking to the business side, the basketball side, almost every day.
I need to obviously ask about the highest and this wasn't exactly through Bo, but it sort of was the highest profile deal you did in the last couple of years, which was buying WeWork via a SPAC. Let me ask this, I guess, as simply as I can, since the stock's trading about 50 cents. What's gone wrong since you invested?
Yeah, I think that when we did it, there was a lot of scar tissue on the company. It's actually a very good business, and it's almost like a $4 billion company. But in the kind of the Adam Newman era, there had been a lot of stuff that had gone on that had spooked.
Do you think you underestimated how much scar tissue there was?
I think that I underestimated the perception that people had about the scar tissue. I think I believe it's a great business, and flex space is here to stay. We have a product that we launched where it's called All Access. It's like a black card. You pay a couple of $100s a month, and you can swipe it in any of the 800 locations around the world. And that thing has become like a $250 million a year business. It's just pure gravy. So there's a lot of great aspects to the business. You
mentioned Adam Newman. I was curious, when he raised an enormous amount of money from Andreessen for his new startup, you read that and thought what?
Well, Adam, I don't know if you've ever met him. But
I have, yeah.
Okay, he's amazing. He's a very charismatic guy.
Charismatic, yes.
And he's, he came to my house. He doesn't wear shoes. And
Wait, so you met him previously? So wait,
yeah.
So why?
Well, he called me up and said, "Will you help me save this company?"
Really?
Yeah. So that's.
So after he's out of it, long after he's out of it.
Yeah. So the company was struggling.
Right.
And so he called me up and said, "Hey, can you help me save the company?" And so I had a long chat with him, and I said, "Tell me everything that went wrong." And I was struck by just how candid he was. And he said, these are all the mistakes I made. And so that's really what got me interested, because he laid out the vision and he laid out what had gone wrong and what was right. And I still believe very strongly in the business. I think that the race is this company going to run out of money first, or is it going to become cash flow positive first? And I think that is kind of the overhang that's been on the business. And they've just raised a bunch of money, so I think that's gone. I think it's a great business. I think it's the future of office space.
Future office, but do you feel that part of the bet you made that maybe went upside down was that more people were going to return to physical offices than have so far?
Well, if you look at the occupancy in Europe, it's very high. It's literally 90%. I think there were a lot of locations where they had signed bad leases, and that's really what bit them.
You mentioned that you're on the competition committee in the NBA, so we have 30 seconds left, so I have two quick questions for you. One, if you could make any one change to the actual game unilaterally, what's your change?
I think that I would...
Please say you want to raise the baskets. You want to raise the baskets, right?
No. The game's actually in a really good place right now, but I still would... the way that some of the fouls, it would be more a point of emphasis that the way that the fouls are being called, I think they need to lighten that up and let them just play.
And then final question, I know you can't bet on your phone right now because it's illegal, but if you were, who's going to win the title?
Well, is it possible for no one to win it? So.
No, outside of a pandemic, no. Somebody's got to win. It's like 6 teams left. Pick a team, any team.
Yeah, I think that it's going to be Lakers and Sixers.
Lakers. And who wins that? Who wins Lakers Sixers?
I think, I hate to say it, because we don't like the Lakers in Sacramento, but I think it's hard to bet against LeBron. So.
Vivek, thanks so much.
Thanks.
Appreciate it.
Thank you.
Introducing our next moderator and health tech reporter for Axios Pro. Please welcome Aaron Brodwin.
Hello. How's everybody doing? Can we get that a little bit louder? Nice, thank you. So before we get started, I just want to remind all of you, you can be tweeting along with us using the hashtag Axios BFD. So I think we've already covered many BFDs in finance. We've heard from many BFDs in climate tech. And now we're about to hear from the only sector that I care about, healthcare. Our next guest has been at the helm of leadership across General Motors, where she spent 25 years, another 4 at Amazon, and now she's the CEO of Alto Pharmacy. Please join me in welcoming Alicia Bowler-Davis. All right, so quick disclosure before we get started. You, Alicia, are a board member as of a few months ago of JP Morgan Chase.
Yes.
JP Morgan is also one of our sponsors of this event. This session is not a sponsored session, it is purely editorial. So now that we have that out of the way, let's get into it, shall we?
Yes.
So you've said that Alto is in the business of improving health and not just delivering prescriptions. Can you tell me more about that? What do you mean?
Yeah, I think when people think about a digital pharmacy, they think about, okay, everything's going to happen online, it's going to be fulfilled and then delivered to me. And that is a very, very important aspect. But Alto is really about improving outcomes, making it easier for, doctors, patients, payers, and pharmacies to operate, because it's a really disjointed system.
Right.
And so we've built this technology platform that enables us to make it easier to ensure patients get the medication that they need at the right time and for the right price.
Yeah. And in terms of outcomes, is that something that you track? How do you know that you're improving health and not just
Yeah, because our adherence rate is much higher. So we have a 40% higher adherence rate, and we track adherence in the fact that people actually receive their medication.
And that's higher than just the standard?
It's higher than a standard walk-in pharmacy. Much higher.
Okay. So you've had an epic career, 25 years at General Motors, 4 years at Amazon. What made you leave all that for a startup, especially a startup in one of the most highly regulated and probably difficult industries out there, healthcare?
Yeah, I enjoyed my 25 years at General Motors. I had an opportunity to work in so many different areas. And then working at Amazon during the pandemic was just amazing. We doubled the company like in 2 years. And so, I was just thinking about what I wanted to do next. And I really wanted to continue working in an industry where I can have an impact, where I could really leverage the skills that I had and make a difference. At that point, it was like, I really want to make a difference. And I met the founders, Matt and Jamie of Alto, and they had, a great start, built this great technology platform, and I thought I could help. And so I said, why not? I kind of was like, why not? I can always go work for another Fortune 50, Fortune 25 company if I wanted to, but why not go work at a startup that was really trying to fix an antiquated system and have better outcomes for people.
So I have to ask, Amazon also has a pharmacy.
Yeah.
Did you ever consider working for Amazon Pharmacy?
I did not.
How come?
I did not, because the role I had at Amazon, I had such a broad role at Amazon. I was responsible for global customer fulfillment. So if you think about all the fulfillment warehouses around the globe, I had robotics, I had technology, I had building design, customer service. I had such a huge remit. And I didn't think being at Amazon doing that, it would make sense for me to go to something that was within Amazon that was totally focused on pharmacy. The difference here, I think, at Alto is that it's more than fulfillment and delivery. It's a technology platform. It's looking at providers, providing solutions for the doctors, making it easy for us to comply with the payers' requirements, and fixing outcomes for patients, and being able to do that within the framework that was established. And if I wanted to change it, I could, right? So I felt like there's a bigger opportunity, I think, the way that Alto was approaching it. And I love Amazon. I'm still a huge customer of Amazon.
Do you have Prime?
I have Prime. I have been a Prime shopper. I think I'll always be a Prime shopper, and I still have a lot of stock. So I love Amazon. I want Amazon to do well. And the pharmacy space, Erin, is such a big space. I mean, it has a TAM of $550 billion. There's room for a lot of people. And I think the more companies that are involved trying to fix it, it's just going to be better for patients. It's going to be better for customers.
So on that note, digital pharmacy is a notoriously tough business.
It's tough.
I mean, your rivals have faced not just massive layoffs, but there's been reports of bungled product rollouts, privacy violations, delays. It's a low margin business. So, I have to ask, is this business model of being a digital pharmacy tenable?
Look, it is a low margin business. I think I have an appetite for low margin. I worked in automotive for 25 years. And it is hard, and it's complex, but it's important. And I do think there's a business model for it because there's a customer need for it. There's a definite, I believe, the way Alto is approaching it, a great product market fit. And I think because we're not just trying to solve it in delivering fulfillment, we're looking at where are the pain points. The founders, Matt and Jamie, they bought a pharmacy. They operated the pharmacy. And they understood where the pain points were, where the friction points were, and they created the technology to address that. And so I think in doing that, we've created value that we, quite frankly, haven't started monetizing yet. Like, we fixed a number of things that we can work with pharma companies, we can work with different payers in order to address some of the issues and not just really focus on the customers that come directly to us from providers. We can provide a solution that will help others as well. And that's why I think this approach with digital pharmacy can be successful. And I think we can even have better margins by applying what's already been built to some of the other problems that are there.
Yeah, tell me more about that.
So when you think about it, pharmacy, you may think about fulfillment and delivery, right? But there's so much that happens upstream from the time the prescription is written in the doctor's office, right? So the doctor writes the prescription, just like any other pharmacy. We receive it through the electronic health records, through the EHR, and then we're able to then take that, intake it. There's a lot that needs to happen with that, then billing. We've automated all of this. So by automating this, it makes higher quality. We're able to do it more efficiently, and then patients get the medication they need. In this automation, there might be therapeutic interchange agreements if one medication was prescribed, but there's another one that's cheaper and make better, then we can swap that with the approval of the provider, and we get that up front. So because we've done that, some of these workflows can be applied to specialty pharmacy, for instance. They do a lot of this, but it's all done manually. We're able to do this with a very high percentage of those workflows being done through automation. And so I think that's where value can be unlocked based on what's already built. And so we can do benefits investigations. We also have a team that can reach out and call and talk to patients and answer questions. And so there's a lot that's there that, quite frankly, we're starting to get some enterprise partnerships and to leverage some of this technology while we're still serving patients directly as well.
My understanding of Alto is that you do virtually no direct-to-consumer marketing.
Yes.
You just do doctor referrals.
Yes.
Does that actually work?
It's worked so far. We're over $1 billion in revenue, and we've grown purely through doctors referring patients to us. And doctors prefer patients to us because, number one, I think we make it easy. We know we make it easier for doctors to manage prescriptions because once the prescription is sent to us, and if there's questions or things that need to be changed, right now that happens at most places through phone calls and faxes. We've created a digital platform where that can happen electronically, and it's just much more faster, it's more efficient, and it takes less time in a doctor's office to manage it. So they see the value. They also see the value in higher adherence rates. And so that's why they refer patients to us. So that's how we've grown. It's proven to be a good channel for growth, but we are also pursuing some other partnerships where we can grow, service more patients much faster.
Okay. I know you made an acquisition not too long ago, an acquisition of patients.
Acquisition of patients.
Tell me more about your strategy as far as build, partner, buy. Why make the acquisition? It was NowRx.
It was NowRx, and it wasn't an acquisition of the company, but the company was going to cease operations, right. And they had patients that were used to this experience of digital. And so they reached out to us, and we were servicing that area, and so we acquired those patients, and we focused on making sure it was just a seamless transition through working with those patients and then some of the providers that were obviously prescribing to the patients. So we did that late last year, and it's been successful. That was a no-brainer, right? That was patients who were used to the type of service that we provide, and in the therapeutic areas that we are also focused on, and so we were able to do that.
Will you remain acquisitive?
Absolutely. I think the organic growth is really important, but I also think that there's opportunities for acquisition that can help us to really grow and leverage the platform that we've built. Yes.
One of the things I still struggle with, I mean, I asked you this already, in a way, digital pharmacy, as I said, tough business to be in. So many of your rivals have seen crippling problems or shut down entirely. Mm-hmm. What do you think Alto is doing differently that's made it able to avoid those pitfalls?
I think the way we've approached the problem, like I said, I think approaching the problem from looking at it from a provider's perspective, payer, pharmacy, and the patient, we've been able to create a solution. I think that is more holistic, and that has created more value and more stickiness, right? And so that's what I think is different, and we have more that we can extract from what's been built. And I don't think...
What do you...
Holistic, because it's just not, hey, it's not just patient facing. It's not just, hey, a patient send us, have your doctor send us the prescription and we'll fill it and ship it to you. It's broader than that because we start with the provider. We start with the doctor. Right. And quite frankly, that's where the prescriptions start. So we start with providing a solution to them that makes it easier. And then we have, we have formularies that we have to comply with the pharmacy benefit managers or the payers, and so we built technology to make sure we're doing that consistently. And then we have a great app that makes it very easy to interface with the patients, or you can do it through the web, or we even have people that call, right? So we've just made it easy, and we've gone after the pain points that exist, and it's very complex. Like, one of the biggest surprises for me coming into this space was, you always hear this business is complex. Everyone's business is complex. This is complex. There's a lot of hands in this space. And I think that's where you follow the complexity, and I think that's where the opportunity for innovation and to find better ways of solving problems. And Alto, quite frankly, has done a lot of that. And that's why I believe we're just getting started.
Yeah.
We are just getting started, and I'm really excited about what we're going to be able to do.
Speaking of hands, you mentioned PBMs, everyone's favorite three-letter word in healthcare. I mean, should PBMs exist? Why do PBMs still exist?
I understand why PBMs exist, because it allows employers. It took me a while, because I kept saying, now what do they do?
Yeah.
How are they creating value? But I put myself in a large employer's perspective, and if I have employees, I want someone, a company with expertise to manage the pharmacy benefit, to really be an expert in managing what type of medications are available, what the cost should be. That's not something as a company I would be an expert in. And so having expertise in that space, I think that's where the value comes in. So that's all I'm going to say. I can understand the concept behind it, but it's still another hand.
Of the behemoth strategics out there, we've got Walgreens, we've got Amazon is one. I wouldn't say behemoth, at least not yet, based on market share. It's pretty tiny. But which one do you think, which one's top of mind for you as presenting a potential threat to Alto or to other independent pharmacies?
Yeah, I don't think about them I think of them as huge incumbents. They have a large percentage of the market. They have lots of patients. They're creating a lot of value, and we're going at it in a very different way. I like to think that maybe what we built may be of use to them potentially one day. So I look at it more as maybe there's an opportunity to partner, and we can help solve this problem together, versus this is somebody I'm going after or someone's going after us. I think, like I said, it's a huge TAM, lots of patients, and there's so much room for improvement in this space. And I like to think about how we can partner.
Could you see your former employer, Amazon, working as a potential partner?
I haven't spoken with Amazon about being a partner, but I think they'd be a great partner.
Sorry for flipping through all these cards. It's my first time using cards. They are very nice, though. So, we've talked about algorithms a little bit and automation. To use, the favorite AI phrase, got to bring it up.
Yeah.
How do you think that's going to change? How is it changing now, what you do at Alto, and how do you think it'll change the next, 5 to 10 years?
Yeah, so we already use AI, in some of what we're doing, as patients come in, and we have chatbots and things like that. But I think the generative AI that we're all reading and learning more about, I think there's lots of opportunity in our space to help with speed, quality, consistency of service using AI, and we're exploring that using this generative AI. I do think we have to, just be careful in how we do that. We obviously have lots of private information, private data for our customers and patients, and so we really need to be thoughtful around using that. But I'm excited about that, and I'm excited about using it where we have lots of manual actions remaining in spite of all the automation that we've put in place, and freeing up capacity for our pharmacists, technicians to do more things that are customer facing and that may not be manual, routine, not requiring a lot of thought. I would rather use some type of generative AI solution for that, and then apply them and their expertise in another way that creates value for the patients. That's the way I'm thinking about it. Yeah. But I'm excited. I'm really excited. I mean, if you talk to the team at Alto, they'll tell you this is something that we are excited about, and we see that it can actually help us to create more value. It's just got to be done the right way.
The digital health market today is not what it was 5 to 10 years ago. How has that impacted your ability to raise capital?
Yeah, look, the cost of capital is really, it's hard. I think it's hard for everyone. And I think, 2 years ago, 3 years ago, I think a very important metric was growth, high growth, super growth. And I think in this environment, you still need to have growth, but you have to have a path to profitability. And you have to be smart around how you're applying that capital, because it is challenging to raise in this environment, right? And so I do think that, digital health, telehealth is still an area that investors are interested in because there's a huge market for it. And anytime you see an area like pharmacy, I'll use an example, is antiquated. It's not a great experience. There's lots of room for improvement. I think there's room for innovation. And I think there'll be capital for companies who show that they can grow and have a path to profitability in this tough market.
Has it impacted your ability to raise capital so far? Are you going to raise again?
We're going to raise again. We're actually actively talking now, and we are going to raise again. Yes.
Good to know.
Yep.
How long do you think it'll be until you start encroaching on behemoth companies, pharmacies' terrain? Is that even a goal? Is that the right?
It's not a goal, but I think we're $1 billion revenue. TAM is $550 billion. The big players have most of that. We're a small percent, and we're just going to keep growing, adding value, and leveraging technology in order to really create these great experiences and services. So I don't know. I think Alto has the opportunity to be a huge player in this space.
I thought about this question when we sat down and I gave that caveat, and I wasn't going to ask it. But now that we have a couple minutes left, I think I'm actually going to ask it. So Alto was an SVB customer. You sit on JP Morgan's board.
Yeah.
How did you navigate that? I mean, I imagine it was a little bit like, there's a fire happening and you're friends with the firefighter. What do you do?
Yeah, I wasn't really friends with the firefighter at that point because I hadn't gone to my first board meeting. But it was like a lot of companies who were customers of SVB, we had all of our money there.
Right.
And so when we started getting calls on that Thursday from some of our investors telling us to move our money, we were like trying to figure out, okay, what does that mean? It was a good thing that we had another commercial account set up, so that we can at least put the wire request in, and we did, but the money didn't move. So we were just like lots of other companies over the weekend trying to figure out, are we going to get our money? How are we going to make payroll? The good news is our investors were calling and very supportive around what do we need to do? We're there. And then I was happy, just like everyone else on Sunday, when I, saw that all of the deposits were going to be insured. And so I was really happy, but it was a very high tense, stressful, and it's kind of, you didn't know what to do, right? So you almost had to wait. But I will tell you that experience has me thinking about risk in a different way.
How so?
Thinking about we had all of our money there.
Yeah.
And so SVB was a great bank, and and there's lots of great banks out there. But I think we just have to think about our strategy around our banking strategy. Where we have money, where we have account receivables coming in, what should that look like? Especially after that experience, if you just do the exact same thing you did before and not learn from it, then I think that's not being smart. So, but that was very, I'd say, pretty stressful, frenetic, uncertain weekend, and I was happy with the outcome.
Yeah. Well, that's a great note to end on. I want to ask you one more thing before we go, which is, you said you're actively raising. Other than that benchmark, what's next for Alto? What should we be looking out for?
I think we're in 13 markets, so we have 13 fulfillment pharmacies. We're able to grow in the existing markets that we have, but we're definitely looking at expanding into more markets as we have partnerships that bring us there. And so I think you should look for us to do more of the great service. We have a great NPS, Net Promoter Score, almost 90. I think the incumbents are -10, and so you can look for Alto to continue to focus on the patient experience and continuing to add value here. So I'm excited. We're just getting started.
Well, on that note, thank you so much for joining me, and thank you, everyone.
Thank you.
Thank you.
Coming up next, we have a view from the top segment moderated by Axios publisher Nicholas Johnston.
Thank you. Good afternoon. Nothing that we do at Axios would be possible without the support of our partners. The investments that we make in journalism, building that deals tracker, which Dan talked about earlier, events like this, all the snacks we've had today, that's all thanks to the support of our partners. So a huge thanks to Latham & Watkins for supporting BFD once again. And I'm very excited to welcome to the stage for our first view from the top, the Bay Area's managing partner for Latham & Watkins, Tad Freeze. Tad, welcome to BFD. How are you?
Thank you. Good.
Let's start big picture.
Sure.
You talk to a lot of interesting people. You hang out in a lot of interesting offices. What is your view of the macro environment, I think, to start?
Yeah, I mean, it's interesting, and everyone's, of course, asking that question. Everyone's anxious. When is the IPO market going to open up? When are deals going to start happening in a big way again? And you're right, I talked to lots of folks about that. Very, very frequently. 2022 was a quieter year than 2021, obviously. We're starting to see a little activity, though, which is kind of good to see and interesting. Had a couple of successful convertible note offerings go out this week. We're going to see it. They were not in the tech space, life sciences, and a REIT. There's going to be a big tech deal that launches tomorrow in the convert space that I think will be interesting and a good bellwether. If these deals trade well, it can mean a lot. There's a couple of large tech secondaries that are going to markets willing launch next week. And so we're starting to see some activity, which is, of course, inevitably leading to talk of markets opening up more broadly.
Well, so what is underlying that? Why are you seeing that happen now?
I think, the markets have been stable-ish. We haven't seen huge gyrations up and down. Dow Jones has hovered in the 33,000 range for a while.
Right.
There's a sense that from the Fed that maybe interest rate increases have maxed out, although the April inflation data wasn't perfect. And I think people, to be honest with you, are ready. That's part of it as well.
When we talked last time, you used a phrase which is interesting. It's like people were waiting for the dam to break. Mm-hmm. So unpack that a little bit. Like, are you hinting that we're approaching that, or is this an easing, like a dam cracking as opposed to breaking?
I'm going to guess it's going to crack first. I mean, there are. I don't know, probably a couple hundred companies that are queued up to go public, that cleared SEC comments, that are sitting around different stages of readiness at this point in terms of how their quarters have gone and what kind of growth momentum they are on. But there are a lot of folks sitting ready to go, including some very large, well-known issuers who you guys write about and others write about. Rumor has that a couple of them are going to push through this quarter or next quarter, really, if they see any window at all.
I mean, what are they waiting for? They're waiting for their lawyer to say, go?
I think they're waiting for a banker to say, we can get you a good deal and a successful deal that trades well, to be honest with you.
Right.
It's probably a little more stability. I think when it opens, there'll be some companies that are ready. There'll be some companies that aren't quite there yet.
When we had John Winkelried from TPG earlier talking about the broader macro environment, he gave a smart brevity answer to Primac, will there be a recession this year? He said no. Do you have a view on that and how that factors in?
It's interesting. I was actually speaking to one of the senior economists at one of the big bulge bracket banks just yesterday on this topic and other topics, and she's pretty bullish. She doesn't think there's going to be a recession. I don't think we generally think there'll be any meaningful recession, even if there is one.
Right.
I think the markets are eager to push through that. She also really felt that there was nothing fundamentally flawed in the economy right now. Very different than 2008, 2009.
Yeah. So on that macroeconomic, there's a bunch of people waiting. Can you parse out sectors that you see more ready or more interesting? Like, where is the deal flow most exciting?
So it's really big name companies that are very, past the point at which I think they were hoping to be before they go public. It is cross-sector. I would say software is probably not in quite the same place as some of the other sectors, just because as spending has been pulled back.
They're a little more victim to the macro.
A little more victim, right? As people have pulled back on discretionary spending, software spend has been less, so maybe a little less there. But certainly some of the folks in the internet space, I think we'll see take a run at it in the near term.
So, I mean, that seemed like a lot focused at the end of the deal spectrum. Are there interesting things you're seeing or trend maybe probably earlier stage? companies?
I think most of them are really waiting to see when the big guys go, and when they do, how they trade.
They'll lead the way.
They'll lead the way for sure. I mean, we've had a few very random opportunistic IPOs over the last 6 to 9 months, some big like Porsche, others smaller in the life sciences space. But I don't think you're going to start seeing meaningful flow until 1 or 2 of the big names get out and trade reasonably well. I think most of the software folks that I work with are really talking 2024 at this point.
Right.
But there are a host of others in non-software spaces that are really eager to see if they can't do something post.
So it's where you see the exit part of the transaction start to become more clear. That's when you see start farther down.
I think that's exactly right. And there's folks all along that continuum, like I said, who are ready, have cleared SEC comments. Most are updating for end of 2022 audited financials and all that good stuff. And so I think there will be a bunch of folks ready to go.
Waiting for someone to lead this parade out. Also, when we talked earlier, you talked about the role that boards play in some of this transaction space. I thought that was very fascinating. I want you to talk a little bit more about like how they are helping to drive some of these decision makings.
So I mean, some of it is just boards are getting tired, right? I mean, it's been a hard, pick your number of months, 12 to 18 months. And we are seeing, a little bit of fatigue and like, what are we going to do? Are we going to just push through and get this deal done? What is next? Obviously, if growth has stuttered or whatnot, you may have a hard time on the IPO path. But we're starting to hear and see a lot more conversations on the M&A side, which maybe is an interesting pivot. Folks who are like, okay, we've tried, we've waited. The resources are dwindling a little bit. Hard fundraising environment. Maybe we should talk about selling ourselves. And you talk to the folks at TPG, those and their brethren are definitely out sniffing around right now.
It's like they have a disposition to action. We want to do something, so let's find out.
We're definitely seeing that with some, and especially for companies where boards are worried that this year could be a down year. Like, do we just pull off the Band-Aid and head towards an M&A exit?
So, from your seat as an advisor on this, like, what do you tell folks? What's the advice you'd give to boards that come to you a little antsy, being like, we want to do something?
Well, I think it really depends. It's super specific to the situation, right? But I think for sure you got to get advisors in and talk about every option and what those options look like, and really have a very, very down and dirty conversation with your management team about what they're seeing and what they're thinking. I've also seen a lot of that over the last 3 months, where 3 months ago there were very rosy projections and they have slowly eroded, and that can lead to quick panic in a boardroom, right? Where the board's like, wait, what? I thought everything was okay, now it's not. So I think making sure you're having real conversations with your finance team, your CFO, your CEO, and making sure you understand where things are going is important. But then talking to advisors about what, how long can you wait? What are financing options? What does the M&A market look like? What might it look like in 6 months? I think those are all good things to think about, and there's not one perfect answer, obviously.
Well, then what are maybe brainstorm a little bit about what you see sort of 6 months out. What are trends you're looking at? Like aside from the macro environment, like waiting for the dam to break, waiting for this IPO market to spin up a little bit. What are interesting things that you hope after that happens might be really interesting?
Well, I do think in the private equity space, right, it's hard right now. Interest rates are high, banks are nervous. The equity checks these folks are having to write are much bigger than they once were, a bigger percentage of the transaction. The LP market, interestingly, where a lot of these folks have turned, so the big PE players, instead of turning to lenders, are turning to LPs, large sovereign wealth funds and the like, they're also getting a little edgy. We've seen a couple instances of LPs pull out of deals relatively late in the process of late. I think all of this will stabilize if I knew the exact answer, I'd be sitting on an island, not sitting here talking to you. Yeah. But, at some point it will stabilize, and I think you will see a big pickup on the M&A side in addition to the capital market side.
A lot of this, it seems there's an undercurrent in all of this is just uncertainty. Sort of our financial projections are weird. The board doesn't know what's happening yet. We haven't seen people lead the way in the IPO market, and so we're waiting for that.
I think so, and human beings don't like uncertainty, and it's been a long period of uncertainty. But like I said a little earlier, we are seeing some signs of stability and some signs of positivity.
So in a horrible metaphor, in this uncertainty tunnel, you see a light.
Yeah, I think so.
The end. Mm-hmm. One thing we love to do at Axios is end on one fun thing. A fun thing to ask a lawyer. What is the weirdest, most random type of deal advice you've ever had to give?
advice. I get asked all sorts of random things. I've been asked everything from, which couch should I buy to which secretary should I hire. But I think that
you don't give that advice. You demur on that, or you have a house answer?
I'm happy to give advice about just about anything. I think people view me as a trusted advisor, so I could ask interesting questions. I think the most fun was I was down in LA, and we had just signed up the sale of Lucasfilm to Disney, and we were flying back up here, and George Lucas had rented a plane, and he was talking to me about the fact that he needs to buy a plane, and it was funny. He was like, Marty has a plane. Steven has a plane. I'm like, I'm not an entertainment guy, I'm a tech guy, so it took me a minute to figure out. But his ultimate question to me, he had just gotten married, and he's like, if I buy a plane, my wife lives in Chicago, I'm probably going to need to buy her a plane. Do you think that her plane needs to be as big as my plane?
wait, what's the advice?
There's only one fair answer, which is, of course, it needs to be as big.
Or bigger, probably.
Or bigger.
A problem I'm certain all of us wish we had.
That's right.
That we could talk to our lawyer about. Tad, thank you so much. All of you stick around. We're going to do a quick 10-minute break and then jump into the last session of the afternoon, sprinting with a couple more interviews, and then we're off to happy hour. So stick around. We'll be right back.
Thanks, everyone.
Take a short break and be right back with more BFD program. One final thing. Remember to stick around for bites and beverages downstairs after our next final segment. Axios BFD will resume in 5 minutes. Please take your seats. The show will start in 60 seconds. here he is again, our View from the Top moderator and Axios publisher, Nicholas Johnston.
All right. We are ready for the home stretch of our BFD, heading straight to happy hour in the NBA playoffs, if you're someone who celebrates. I'm very excited about our next guest. Like I mentioned, everything we do at Axios would be impossible without the support of our partners. And JP Morgan has been a great friend of Axios since literally day one when we launched in 2016. And they were also a partner of our very first BFD in New York. So I'm very happy to welcome to the stage, for the first time ever in the history of BFD, a repeat performer on the stage, JP Morgan's global head of M&A, Anu Iyengar. Anu, welcome back to BFD. How are you?
See you.
So let's start. This is the first time we'll ever get to do this on BFD. We love asking people for predictions. You are the first person ever who will be called to account for those predictions. When we talked in November, I asked you for what would your BFD in the next 6 months would be. You said it would be something that would be proactive and strategic and probably involve health or ESG. Were you right? And if you were, what qualifies for that BFD?
Phew, that was lucky. So that's good. Actually, that was pretty good. So as predictions go. So strategic, I'd say in over a decade, largest number of unsolicited strategic approaches being made. You've seen 10 plus such deals already announced, and there is 10x of those in terms of conversations that are happening. Healthcare has also been one of the most active sector. And I think you all did a little breakout on clean tech.
Right,
I'm sure.
right.
So ESG is also actually all three.
Well, congrats.
We're doing well, Nick.
All right. Well, so let's take that and now let's blow it up much bigger. Let's start like we just did with Tad on your sense of the macro environment. And we can dig in a little bit what you talked about, I think when we spoke in the fall, that it was a buyer's market.
Yeah.
Is that still true? And what is your view of sort of the broader macro trends now?
Still a buyer's market. So the macro is not helpful, right? So M&A is a confidence game. So it turns out that when you feel confident, you feel good about the world, you do more M&A. You would think a little bit the other way, right? Because you would think when valuations are really high, situations are very competitive, maybe people do less, but in fact, that's when people did a lot of M&A.
Right.
Today, valuations are much lower, situations are a lot less competitive, and you see less M&A. And what's the difference is how good you feel about the future. And when you look at all the challenges, the macro challenges that exist, that does give people pause. But having said that, if you are an investment grade strategic buyer and you don't do a deal now, you're going to kick yourself.
Why?
Because this is the best environment. Because the targets that you looked at previously and for whatever reason didn't buy, it's a better valuation today and there's less competition for it.
Right.
That asset is not proactively going to likely come to market. So you're going to have to go knock on the door. That's why you see a large level of unsolicited activity. Still friendly, but buyers proactively going and saying, maybe we should have a conversation.
Well, so this is the same trend as we talked about in the fall as being a buyer's market. Like if you have capital, you have access to financing, this is a great time to go spend it because the assets you're pursuing are probably a better value.
And not everybody does have access to the same capital that you do.
Right.
So you have a competitive advantage in terms of synergies, you have a competitive advantage in terms of cost of capital, and you have a competitive advantage because the overall field is smaller of the companies that are chasing the same
Right.
target.
But you've talked about it being like a factor of confidence. And even if you have a lot of capital and you're well positioned for that, well, you're in boardrooms a lot. Like this is why I love talking to you because you talk to all these people and hold their hands and talk them through that. So tell us what that mood is like and how you work them through kind of this idea of like maybe this market is a little murky or as Tad said earlier, it's waiting for something.
So I think whether you're a buyer or a seller, the boardroom dynamics are a bit different, right? So when you're a buyer, many companies, not all, I think everybody should, but many companies are just taking a look at every file that you looked at in the past.
Right.
dusting it off and saying, okay, what does the math look like today? Should we look at it? There is a little bit of an element of greediness to say, maybe if we wait a bit longer, it can be even more cheap. I would
we talked
caution
about
against
last
that.
time is like, don't wait for that.
Yeah, don't wait too long, because it's a little bit of, does it really matter if something is going to go this way? Does it matter whether you catch it here or catch it here? And sometimes it may be easier to catch it on the way down as opposed to trying to catch it on the way up.
This is a market timing argument. It feels
Exactly.
like. You're not that smart to figure that out.
Yeah,
Exactly
and
that
so if it makes sense and if it's strategic, then go ahead and do it. And I'd say boards are actually pushing sometimes management teams to actually go ahead and have a leap of faith.
Well, this is exactly what Tad said too, as far as boards being the driver of
That's
these
right.
kinds of conversations, because they're looking more strategic than maybe the management team that's a little nervous.
Well, I'm glad we are both seeing the same thing.
Okay, your lawyer and your banker are
Yes.
telling you to make the transaction.
And we are both in the
Read into that.
boardrooms.
You will.
Exactly. But I think on the sell side, though, nobody wants to proactively put a for sale sign, right?
Right.
Because there's a little bit of, if you do say, I'm for sale, what does that mean? Is there something wrong? Why would you sell yourself?
Why would you say that in a market that's...
Yeah, why would you sell yourself in this market? But being passive is also not the answer. You just don't sit there and wait and hope that nobody comes knocking on your door.
Do sellers, though, if they're not putting up the for sale sign, when the phone rings, do they answer? Maybe not on the first ring, you have to call back?
Depends on who's calling and how buttoned up they are. That's a very important question, right?
Well, unpack both of those. Whose phone gets answered and how buttoned up do they have to be?
So if it is a very logical strategic who has financing lined up and there is not a meaningful antitrust risk.
Right.
Right? So if I'm scripting the person who's making the call, it is, look, this makes a lot of sense and here is why, and we've looked at the company. It's not that I'm making 5 such phone calls, I'm calling you. And here is why, and we've done a lot of work. And I have the money lined up, and I have done the antitrust work outside in, and I'm confident this deal can close.
So it's like there's like a less room for error. It's not a willy-nilly deal making. It's
That's right.
very, very specific and direct, and you show up with the documents and you're ready to go. Money.
And if you are the person receiving the phone call, you're very prudent to ask a lot of questions and make sure that your time is not getting wasted. This is not somebody just, there to do some diligence and learn more about you. You want to make sure they're serious.
Right.
They have all the approvals in place, they have the money, and the deal can close.
It's very deliberate, it sounds like.
Very.
Tad mentioned when we were on before this sense of waiting for the dam to break. I would be very interested to hear your thoughts about that. It's like how people feel, again, on the confidence thing. Like once a couple big deals go through, are people like, oh, okay, now we're ready again? Or is it a little different from your vantage point?
I'd say it's less about just seeing deal activity. It's more having some sort of certainty in the macro environment. So, for example, if you knew that interest rates hikes are done, or you have a sense of are interest rates going to come down, are they going to stay where they are you going to solve for a 2% inflation? Doesn't look like it's immediate, so what is the path to that? What do we think is going to happen with we are still in the middle of a war, right? So geopolitical risk, the debt ceiling is a big part of the conversation.
Yeah.
Right? So the number of unknowns, the more they are, it's harder for you to come up with, here is the environment in which I'm doing a deal.
There's still a lot of uncertainty.
Yes.
That factors into all of that. We could do this for 30 minutes again, and I'm already getting this thing flashing at me. So let's spin it forward to the next one. What's your BFD prediction for the next 6 months?
I'd say if you're a seller, don't sit there and be passive, right? So
People are going to start putting up for sale signs?
No. Instead, take control of your destiny, figure out options, so that when somebody is picking up and calling you, you're not just reactive. You're figuring out your own options, because maybe you should look at going and buying something and increasing your size. Maybe you should look at having some friends lined up that in case you need to call them, you know who to call. Maybe you should develop a point of view as if there are these 5-10 people who call, how do I want to react?
So it's it's proactive, but maybe a little further down the food chain. And then
Exactly.
final question, do you have again, on industry sectors, verticals, still healthcare, ESG, or is there anything else over the horizon that gets really?
I'd also say that I think if you are looking the next 12 months, I think the places to hunt for deals, right? Companies that went public in 20 and 21, but haven't done a follow-on offering. Good quality companies that went down the de-SPAC route.
Right.
There's some really good companies there. Some of them have very few. We've done 3 deals in that space. Many more should happen. Companies in the VC portfolio and sponsor portfolio, which we're looking to go IPO. All of this is good hunting grounds.
Interesting. This is not, you're not giving me an industry answer, you're giving me a life cycle answer.
I'm giving you where to go hunting to find the next deal.
Perfect advice from a banker.
Happy hunting.
What would you expect? Anu, thank you so much for being the first ever second-time appearance.
All right. Good to be here. Thanks for having me.
Please give a warm welcome to Axios senior business reporter, Hope King.
Good morning. I'm going to see who is paying attention, who's still awake. Hi, everyone. It's so good to be with you here in San Francisco for our first SF BFD. It has been amazing to hear these conversations in your backyard. And I have the great privilege and pleasure to talk to our next guest, who is currently at the helm of a company founded 170 years ago, invented the denim blue jeans 150 years ago with their first product, the president and CEO of Levi Strauss, Chip Bergh. Please join me in welcoming him. Hey, great to be with you. Thanks for making the time for us.
Great to be here. Hi,
I know, it was very on brand.
I met the Pope wearing jeans. It's in my contract.
I was going to wear one, but I felt like that would be overkill. Figured you'd do
I've got you covered.
Your part.
I've got you covered.
Let's get it out of the way. Skinny jeans. You are adamant that they are not going away, that every woman still wants them.
Yep.
What is the most underappreciated fact or quality about the skinny jean?
Well, that they are never going to go away. I mean, in fact, we were in a meeting. I was in an executive team meeting today, and we were talking about this very thing. The big trend right now in denim is looser, baggier fits. It's what all the cool kids are wearing. The good thing, it's a new denim cycle, and the good thing about it is it's both on the men's business and the women's business. It also plays right to our sweet spot, the 501 jean, which we're celebrating the 150th year of. Right now is a straight jean. And the 501 is growing. It grew 50% last year, it grew 25%, off of 50% in the first quarter of this year. So the looser, baggier fit is where it's at. But I did say on our last earnings call that the skinny jean is never going away.
And why is that?
It's
for both men and women, right?
More on women's than men, let's be clear. But it's a staple in women's closets, and and it will always be a staple, I think.
And from your perspective, you got teenage kids.
I do. One teenage kid,
okay.
And then 2 grown men.
What does your teenage child think about the trend of skinny jeans, since they're onto something else?
Oh, she is buying the naughty boot cut. That is her cut right now. That's the fit of her choice, which is a looser, baggier fit.
You're celebrating these milestones, 170, 150, Disney is crossing 100 years, Starbucks just recently crossed 50 years. What is the key to longevity for a brand?
Well, I've worked in 3 places my entire adult life. The U.S. Army for 4.5 years after I graduated from college. I was an officer during the Cold War in West Germany. Then I spent 28 years at Procter & Gamble. Procter & Gamble is, I think, about 186 years. U.S. Army's 250 years. And then Levi Strauss, that's been around for 170 years. And I would say that the key thread through all three of those, I call them institutions, is their values. And that's always been really, really important to me. But the values that I learned in the military carried forward with me the rest of my career. I learned everything about leadership when I was in the Army, and then built upon that during my 28 years at P&G. And one of the things that attracted me to Levi Strauss was the values of our company. This is a company that's not afraid to take stands on important social issues of the day. We put our employees first, always have and always will. And those are the things that attracted me to it. But I do think, and I know there's a lot of people here probably from the startup community, and I've done some angel investing, it's like the last thing a lot of companies think about when they're forming and storming and norming. And I think it is really, really important because I do think it's the key to longevity. Well, and I like to say we're the kind of company where we're all about doing the harder right over the easier wrong.
Since we're talking about it, let's just talk about it because I had it prepared for later. But when you look out into your industry and beyond, is it easy for you to tell when a leader is making the choice that is the easier wrong?
It's not always easy. Sometimes you find out about it after the fact. But it is one of the things that I try to talk about a lot as the leader of the company, that we need to be prepared to make the harder right decision over the easier wrong decision, and be prepared to live with the consequences of that. And so, it's not always evident on the surface, but, time catches up with people.
What is an example of a decision that you made that you knew had to be the harder right?
Well, there are a lot of them. On the one hand, exiting Russia was one. It was a very big, profitable business for us. I think a lot of companies that had a business in Russia struggled with this. It's not so much we made the decision to exit, it was how we exited. We fulfilled all of our lease obligations. We had about 800 employees, and when we had to exit all but a couple of those employees, we paid them all packages. We did it the right way. Those were team members. Those were members of our team, and it was hard. It was very, very emotional, but it was absolutely the right thing to do. We could not continue to do business in that country. And it was one of the highest profit margin businesses that we had.
We are on the topic now of this international conflict. The big theme sort of carried over from last year is the idea that investors want to de-risk, companies want to de-risk their supply chains. When you've been in charge of businesses in India and Southeast Asia, Australasia, what does the world still get wrong about that region of the world?
Well, first of all, there are a lot of good suppliers out there. I think there's a perception that, everybody's corrupt in that part of the world, and that is not the case. We have a big global supply chain, for example, and we have de-risked China, to be very, very clear, and we've talked about it on earnings calls. I think when I joined the company, almost 20% of our sourcing was done in China. Today, it's mid-single digits of our total sourcing. And the amount of product that we import here to the United States is less than 1% coming from China. So we've really de-risked our source dependence on China, going all the way back to when the tariffs started. And that, fortunately, helped us through COVID and everything, because a lot of companies got very, very caught up with an overdependence. So we've tried to, we're a big global company, and we've got a big global sourcing base, and we try to have a very diversified sourcing base so that we aren't overly reliant anywhere.
And I think, one of the benefits of being a business leader is that you play a role in diplomacy when you have businesses abroad. In 2016, before the election, I had asked Jack Ma and my team at CNN about trade, and he had said that when trade stops, war comes. In what way do you think that international trade actually contributes to gaps in diplomacy?
Yeah, well, I think there's little to dispute that there is some decoupling happening right now. And there's a lot
Decoupling or de-risking? Because I've heard...
It's both. I mean, slicing hairs, I think, between the two. But it is, de-risking is resulting in some decoupling. And Thomas Friedman has written about this too, that the more decoupled we become and the less interdependency there is, the greater the risk of something really consequential in terms of hostilities goes up. And I'm not a foreign affairs expert, so I'm the wrong guy to ask about this, but I do think that when there are interconnections and interdependencies, that it forces us to be open and to have dialogue and to work through issues, and so there is some good that can come out of that.
And common threads, pun intended,
right.
With the brand being there and people being able to identify that. But how realistic is friendshoring, especially when you look at the inflationary environment that we're in now? A lot of companies are looking at this, but I think the concern is that prices will have to go up to make up for the difference in labor costs.
Yeah, so we do have a big global sourcing base, and we have sourcing countries here in the Western Hemisphere. We do quite a bit of sourcing out of Mexico. I actually believe we used to have factories here in the United States, and we exited the US and went overseas. We were one of the last ones to go, actually, and it almost cost the company its life because we became so cost uncompetitive in the late 80s and early 90s. But we did eventually offshore all of our production, and as I said, we're spread out all over the world. I actually don't think those are the kind of jobs that should come back into the US. I mean, we're already almost at full employment anyway, and to make a pair of jeans, we still make them pretty much the way Levi Strauss did himself. I mean, we don't cut the fabric with a pair of scissors. It's all computer-assisted cutting, but the sewing and everything is done very manually, and it's low skill, low-cost labor, and that's really not the kind of labor I think we should be trying to bring onshore here in the U.S. We should be moving up the value-added curve from a manufacturing and sourcing standpoint. But there are opportunities to continue to be moving more production closer to the region. This is still our biggest market. It's almost 40. The U.S. is almost about 45% of our global revenues. And the closer our supply chain is to the market, the more agile we can be and the more responsive we can be. So there's a lot of benefit to that versus needing to ship it across the ocean coming from the other side of the world. And that agility in the apparel business, especially when you're chasing trends in fashion, it's really important. So we are trying to find the right balance there.
Perfect lead into the next segment here of our conversation, which is apparel. You've done tremendously well in growing the women's business, the tops business, which has not traditionally been a strong part of your business. What differences, though, does that make to your strategy? Because chasing jeans, which last a long time, versus fast fashion and tops that you need to change every season. I mean, that's a game that the fast fashion players are in. You're getting into that now. So how will that change your business ultimately? Because then you're operating on a kind of completely different level.
Yeah. Well, first of all, we're the opposite of fast fashion. I like to say we are slow fashion. We are quality that never goes out of style. And we do compete with fast fashion to some extent, but when I joined the company 12 years ago, we were basically a men's blue jean bottoms business sold in U.S. wholesale. That was basically our business. That was about 60% of our business. Today, in our strategy, and the company was, not performing. It was a big turnaround situation. We were still private at the time, and our strategy was we had to protect that core business, that profitable core business, because it is what generates all the cash and a lot of the profit. But that business we've got very high market share. It's slow growing. Low single digit growth is kind of the best you can expect out of something like that. So to grow, we had to do other things. We were way underdeveloped in women's. Most apparel brands, the women's side of the business is bigger than the men's side of the business. And women buy most men's products. So we didn't have women coming into our store. They weren't buying for themselves and they weren't buying for their husbands. So it was clearly an opportunity. It was about 20% of our business, a little bit less, about 20% of our business when I joined. It's now over a third of our business and growing double digits. And then tops was the other obvious choice. I mean, when you go in to buy a pair of jeans, it's kind of natural to buy a t-shirt, And so our tops business was really, really small. We've grown that business significantly over the last couple of years. And those two things have been a key driver of our growth. And it was strategic. Those were strategic choices that we made to get the company back on track.
People are more aware of their gender identities. Globally, according to a recent study, about 1% of adults currently describe themselves as transgender, non-binary, non-conforming, gender fluid, or in another way. Bud Light's recent marketing stunt shows where the backlash can come from. How do you market products in a world where, you've said this before, everything can be very politicized, but where people are, again, more aware of their gender identities?
We actually have a gender-neutral line. It was a small collection. And we know that women buy some men's product and men buy some women's product. We know that goes on. We've got the research and the data to show it. And that's great. And we are kind of building out slowly, starting with a very small collection, a gender-neutral or gender-fluid line. And there is definitely consumer appetite for that. And we're there for that.
When you look at the consumers today, you look at the pandemic, many of us changed sizes, either up or down. In my case, it was up, and I tore my first pair of jeans ever recently, which was really fun. And where I'm going with that is vanity sizing is a thing. Where I am definitely not that size anymore, but somehow I'm still fitting into a size that is what it was in the pre-pandemic. How much are you doing with your clothing?
I would say we're not doing any, but I will also say at the same time that size consistency from one fit block to the next fit block is always an opportunity for us and for everybody else. So said differently, a 26 waist is not a 26 waist across every single item in our line, or if you're a guy, a 32, 34. There's variation between fit blocks, in part because of where it fits on the waist. And that drives people crazy, because if I know I'm a 32 waist and I order a 32 waist in a different fit block and it comes and it's too tight, it means, especially if I ordered it online, it means I got to return it, and that costs us money. And it's a hassle for the consumer more than that. So we're trying to get more consistent and get better at that, but it's a source of consumer dissatisfaction. But we don't mess with sizing intentionally to do, vanity sizing. That's just not right.
Speaking of returns and logistics, Amazon is now launching a Buy with Prime sort of service for other retailers. Do retailers now have to amp up their logistics in order to compete with the delivery experience of Amazon?
Well, I mean, basically whatever Amazon does, it sets a new standard, and that becomes the consumer expectation. I mean, my household, sometimes my front door looks like a loading dock. My family orders so much stuff from Amazon. So it does set the bar. And when they went to, 2-day delivery, and then sometimes now 1-day delivery if you live here in San Francisco, that becomes the challenge for, companies like us. We have to figure out how do we compete with that. And so logistics is an important criteria. We've had some competitors that have gone out and bought logistics companies. Good for them. I'm not sure if it's working, but I don't think we'll do that. But figuring out how to compete with Amazon, it's not competing with Amazon. It's really meeting that customer expectation, that consumer expectation, where the bar just keeps going up.
Right. Really quickly on AI, metaverse, NFTs, your brand dipped into all of these things. Does this really drive sales in the interim when you put out a marketing push toward any of these new technologies?
So we're kind of tiptoeing into most of this stuff more as a fast follower, or maybe even slow follower in a couple of areas. We've done a couple of NFTs, but the one place where we are really investing is AI. And we built up an AI, a data science organization over the last 3 years. I mean, I jokingly say, we're right down the road from the ballpark where the Giants play. The Giants have been doing data science since the 1990s. And we're just starting. I mean, we're 3 years into it, but we're definitely getting value out of it. We use it for pricing and promotion. We use it when you go to the website There's data science behind it, so that when we know that it's you, the landing page is customized to you. We can recommend items based on what we know you've bought in the past. I mean, so data science, that we're using it now to help us make real estate decisions on where we're going to put our stores.
From a consumer perspective, I guess to be more specific, do you see an immediate lift in interest in sales when you talk about a new NFT project or a new metaverse project?
No.
That's what I thought. No. So we talked about how outspoken you are. Many CEOs, when I ask this about how they decide when to speak out, say, "Well, I only want to talk about an issue that might be relevant to my company, my brand, my industry." Do you think that's a BS answer?
No, I think it depends on the company and the business. I think there's probably that's a good starting point, I guess. But for us, it is, again, going back to our values and who we are as a company. This is something that this company has a long legacy of doing. We're $6.5 billion in sales. But we have such a long legacy of not being afraid to take stands on important social issues that we punch way above our weight. So, if you go back to 2016, 2017, when the immigration ban went into place, that day we pounced on that and said, we're going to stand for immigrants, we're going to stand for the immigrant community. We rallied, we put some money, some support to help with the crisis that happened kind of overnight. And the next day, the headline in the paper was Apple, Google, Facebook, and Levi's stand up for immigration. And those were all trillion market cap companies, and we're 10 billion market cap at the time, maybe 10 billion. We're less than that right now because of the market. But we punch way above our weight and just have this long track record and legacy of not being afraid to take public stands on important social issues.
I only have 1/3 of the time that I wish I had with you. So my last question for you: you were also at P&G in charge of male grooming. There's a Nelly song about women looking into the mirror and talking to their friends on the phone. Which insecurity, what are the most things, which things are men most insecure about?
Which things what?
Are men most insecure about when it comes to their appearance? Having been on the grooming side and now on the apparel side.
Men aren't insecure about anything, right, guys?
I don't think I can leave you with that answer. You have to try again.
Gosh, I don't know. Their hair? Yeah, I guess maybe the hair thing is probably something a lot of guys have to deal with. But
and no skinny jeans for a reason, right?
Yeah, well, I don't know. Mine are kind of tapered, but no. I mean, we do sell skinny jeans for guys, and there are some guys who can really rock it. So.
Case in point.
But yeah.
I'll let you off the hook.
All right, good.
Drink soon. Thank you, Everett and Shipberg. It was so great to talk to you.
Thanks.
Thank you.
Up next, we have another segment moderated by Axios technology and business reporter Kia Kokolacheva.
All right, I know you're all looking forward to our happy hour, but just hang in there for one more guest who's been in the venture and startup world for a really, really long time. And at the beginning of this year, he took on one of the biggest jobs in the industry. So please welcome Y Combinator CEO and President, Gary Tan.
Thank you for being here. Great to see you guys.
All right, so we got to be super entertaining to keep people here. So you started your official job at Y Combinator at the beginning of the year. You went through one batch already. So my first question to you, selfishly, is Are you going to bring back demo days in person? Because I really miss the soft pretzels we would get during the breaks.
I'm thinking about it. We're bringing back so many aspects of YC to in-person, and then demo days on the list, but there are a few other things we want to do first. We're actually bringing the whole, almost all of the batch. So we used to have an option for people to do Y Combinator remotely, and this is sort of the first one where we really, really think people should be back in San Francisco. This last batch, 86% of people did come back, and the feeling was awesome. So we think it'll get to 99 or 100% this time.
Okay, but demo day, are you getting like pushback on that, or?
Well, the interesting thing is that demo day done on Zoom means that the founders can raise more money. So that's one of those things. YC always will be about making founders as successful as possible. So if we can figure out a way to not mess with that, we might actually just throw a bunch of really great parties, including for VCs. So, and press.
Fair enough, because I know the VCs love to gossip about YC demo days. That was like the top activity. So one of the biggest changes you made so far in your short amount of time at the helm of YC has been winding down the Continuity Fund, which was the late stage investing vehicle. Why?
Well, like anyone, as a new CEO coming into a new role, one of the most important things is to try to focus and try to figure out, what's funny is we actually tried to do office hours on ourselves, and we said, what is the thing that is hyper unique about YC? And for me, having gone through the program, being a partner there previously, I just realized early is why YC exists. And in the first 100 days of coming into a leadership role, you got to sort of make all your changes. So
that's very presidential.
Yeah, and that was what I wanted to do was, really do the right thing for our community. And it was a really, really hard decision because we let go some really amazing, really smart people. But at the same time, it's really about how do we serve the founders. And this was the best way we could do that.
Was the most recent Continuity Fund like fully deployed? What was the status?
Oh yeah, we're still deploying some of it. And really the focus for me is YC's pro ratas are incredible, and we're just going to keep doing that. And that I've actually been sort of on a listening tour with all of our best partner VC, GPs, managing directors at all the firms you could think of. And the number one thing there is that we can be far better partners to all of the people who we've already made a lot of money with. I mean, you look at every Sand Hill Road VC firm, and there's usually a fund returner that was a YC company. And so we just want a lot more of that. And this makes things a lot simpler on that end.
So they're just happy to not compete with you as much?
Oh, we can be friends better. We can be much better friends.
Okay, fair enough. The Continuity Fund was actually something that one of your predecessors, Sam Altman, had set up during his time in your position. Is the implication that was a mistake?
I think that they did incredible work. And some of it was like bringing YC into the future. I mean, you have to remember, today YC will actually invest $500,000, but in the early stage. But when I did YC, I think we got $12,000 for 7%. So, the world's YC early was a very fringe thing. Like people really didn't understand that you could fund people in batches and then have actual real good outcomes. I think the Airbnb investment was something like $18,000 that returned more than $2 billion. So it's pretty astonishing that that happened. And of course, as something becomes successful and more well-known, I think that how you fund it, whose money you invest, YC went from a very fringe thing that was a very successful startup into now something that is really a part of the firmament of venture capital. And when Paul Graham and Jessica Livingston started YC, I don't think they had any idea that that would happen. I'm pretty sure all they wanted to do was help people just like them who were very technical, who had never started something before.
Is the current venture environment, did that impact the decision, sort of the ability to make growth investments?
No, I mean, a lot of it really is about, how do I make those 12 weeks when people come in and they sometimes are just the team. Like, increasingly we're experimenting again with no idea teams. And actually, it's sort of amazing how many of the companies in the batch, some crazy percentage of them actually pivot during the batch. And so really it's about how do I get as many people working at YC? We're only 80 people now. How do we get as many people on that team to be rowing exactly in the same direction, which is what do we do to make a lot more magic happen when there are 2 or 3 people who have never started a company before? What do they need? And let's focus on that.
What are some other major changes you want to make?
Well, it sounds like bringing back Demo Day might be something I need to get on. I think that this craziest thing is, I'm sort of a customer. I mean, when I first found out about Y Combinator, it was actually because I was at Palantir. It was 10 people in a room in Palo Alto and Page Mill Road, and our whole thing was how do we hire the best software engineers that everyone knows? And so we would basically take people to lunch and try to get them to quit their jobs. And so the only 2 cults that were more powerful than Palantir at the time in my memory was Facebook, which ended up being a much bigger outcome, and Y Combinator, where we met YC founders who had given were given $12,000 for 7%, just like I did a few years later. And I remember they would just not quit. They were like, nope, we're working on our startup. And then I remember right after that, they left, and then the chatter in the office was like, haha, look at those chumps. They took, they gave away 7% of their company for $12,000. And of course, I was working really, really hard at the time. I think I was sleeping in the nap room on Page Mill Road. It smelled horrible. And, I was coding and designing until, 4 a.m. And I'm sitting there staring at like the popcorn ceiling thinking, wait a second, those guys might have only gotten $12,000, but they own 93% of their company. I'm working like a dog for Peter Thiel for 25 or 50 basis points of this company. Who's the real chump? And so that's like sort of the key thing about YC. I think that we can continue to build that. I ended up finding out about Hacker News. I read all of Paul Graham's essays, and then I realized, oh, I wasn't meant to have a boss. I could actually own the equity in the business that I create, and I can actually be the person who takes advantage of my own work, my own labor. And that was such a powerful idea that I think that's what YC needs to continue to be about. Like, startups have continued to grow, and then the thing is you can't do it alone. And I think YC, to me, is like the most powerful community of people who use each other's services, and then more importantly, like when you get punched in the face, when you lose your best customer, when your director of engineering quits, when horrible things are happening, when your lead investor pulls out, you have not just, a lot of founders, frankly, outside of YC, and I remember this from when I was starting my company in 2008, you have no one to talk to. Like, do you think that you can go to an event and sit next to someone and actually spill your guts on what's happening? You can't, because you're sort of stuck in this killing it culture. Like, I'm killing it, you're killing it. You don't share what's really going on. And I actually think that one of the reasons why YC can be so successful is that there's a culture of people actually helping each other. And it's more or less priceless. Like, community is super priceless. And so that, that I think is the future of YC. Like, we're going to continue to do media. We're going to keep teaching people, hey, you weren't meant to have a boss. We're going to continue to build software. I built an internal social network that's used by 1 in 3 founders in the network every single day. And that's where we're sort of sharing the real secrets about how to do things. It's sort of the core of our community. And then at the end of the day, like, we're going to continue to scale capital and our resources in terms of the people who can actually help. And the coolest thing is, like, I think we're going to continue to grow our partnership. We're actually going to continue to have the best founders go through the program, and then increasingly they're going to come back and be group partners. They're going to be the people who are shepherding the next generation, and I just want all of that to go a lot faster.
I just love that you just called Palantir Facebook, NYC cults. I mean, that's
A good cult. It's a religion.
Going a little bit back in time, you actually left a job to take this job, and that job was leading Initialized Capital, a venture firm that you co-founded over a decade ago with Alexis Ohanian and Harj Chagar. But you were the last co-founder left. How were you able to leave your venture firm, legally speaking? I know there's a lot of questions around the fund you had just raised. Were you the key man? Were LPs okay with all of that?
Yeah, of course. I mean, off the bat, I have to point out, I always wanted to build Initialize sort of as a team. And when Paul Graham and Jessica Livingston came and asked me to consider coming back to Y Combinator, the first thing that was in my mind was, how do I make sure that our team, the team that we've built, they can stand there on their own? And then the really great thing is, Brett Gibson, he's one of the best hackers I've ever worked with. Like, we started multiple companies together. He actually built a bunch of the software at YC2. So we worked together for more than a decade. Jen Wolfe was actually my mentor very early. Like, I was actually a 16-year-old intern down the street working on a web design firm. And she taught me how to take the bus back to Fremont, where it was like, so these are some of the people I trust the most. And, we managed to figure out a way. And the best thing is, like, they can continue to do the great work that Initialize, we set out to try to build the best seed fund, the fund that would help people, really go from 0 to 1 and then 1 to, $1 billion. But, it's sort of working out great. Like, I can go back to where I started, and then I've given the fund actually to the new managing partners. And I think they're really on a true track for success.
So the fund survived, the LPs blessed it, you're able to leave, and it's in good hands.
Absolutely.
Okay. For the last few minutes, I'm going to shift gears, and we're going to talk about San Francisco, because we're here. And Gary is one of the most vocal pro-San Francisco tech people, which the numbers are starting to dwindle. I know you're very invested in the city, not only surviving, but thriving. What are your top 3 things in your wish list that you want City Hall to do?
Oh, God. I mean, I think number 1 by far has to be, we need to do something about the fentanyl crisis. And, this drug that's on our streets and like right outside of our doorstep, nothing like this has ever existed before. And it is, more people died from fentanyl overdoses than COVID, actually. It's something that is truly scary. And I think we desperately need recovery. We need treatment options. And that's something that I'm very worried about. Like, I think that the city does not invest in recovery. I'm a big fan of harm reduction as well, but I don't want to get in the weeds on policy. But zooming out, I think the most important thing is that the people in this room, especially if you live in San Francisco, you have a voice, and we're being heard now. We've recalled the DA, we've recalled school board members, we've actually removed a sitting far-left supervisor from the west side, which has not happened since district elections has gone in. So I think that, on the one hand, many of our friends have left, but for those of us who are staying, we're gonna win. 2024 is the year where we make San Francisco common sense again, and I'm really excited about that.
Okay. Fair enough. Work from home is an interesting topic. We're seeing some tech leaders not be okay with it anymore. They think people should go back to the office. Sam Altman was talking about that recently. And then we're seeing elected officials be in favor of going back to the office, seemingly as a solution for the downtown office vacancy challenges we're facing. How do you view work from home and return to the office?
I think there's really 2 phases to every startup. There's the 0 to 1 phase where you don't know what your market is and you're still trying to figure it out. For that phase, there's really no substitute for being together. But I think we're seeing really great companies show that hybrid or remote can work for those later stages. And then can I share a dream of mine?
Please.
I think my dream for San Francisco is that Y Combinator, we want to bring the world's talent to bear in San Francisco. We want to go deeply in person. We want people kind of like, just like in Rome and Athens in antiquity, people would send their best, smartest people from all around the world. I mean, I'm looking out on this audience, and people in tech are some of the most diverse people from all around the world who come here to come to San Francisco to exchange notes, to meet each other, to become trusted friends of one another, so that we can actually go build products that touch billions of people. How cool is that? And so my dream, both for YC, but for also all of us in tech, is that we're going to fill every single new and old office building that's empty right now, and we're going to fill it with brand new companies creating new products, maybe powered by AI. And these are things they're going to touch the entire world, and we're going to build it right here.
So it sounds like you're kind of into the office sometimes.
I mean, I think 0 to 1, like, I highly recommend it. Like, if you put 0 to 1 team versus a remote 0 to 1 team, the one that's staring each other in the face and being able to have super high bandwidth communication, they're probably going to beat the other team 9 times out of 10.
We're coming up on our time, but I do want to bring back something you said earlier about folks from the tech industry who live in the city being able to vote and sort of make their voices heard. And I know that if you talk to some folks from underserved communities in the city, they would say that actually the city has been doing a lot of pro-tech industry policies for a long time. Mayor Ed Lee was famously a fan of the tech industry. We had the controversial Twitter tax breaks. How would you work with folks who are trying to solve San Francisco problems and who have that view?
Yeah, absolutely. I mean, I think there's a lot of people who are very common sense. We got to support them. We got to support them and tell each other. We need to work on their campaigns. We need to donate to their campaigns. I think.
But how would you work almost like across the aisle with folks who?
Well, we're all Democrats here, so that's the thing. There's no aisle here. I think ultimately, tax breaks or not, like, I sort of don't think that that's the important thing. What I want for the city is that we should have safe streets. We should have enough housing. I think housing was like sort of my first realization that, if we're not building new housing, then, if tech people are leaving, it means everyone else also cannot stay here either. And they might blame tech, but we have a role in fixing it. And that means, yes, in my backyard, we need to find and we need to vote in candidates who actually legalize building housing. It's pure market forces here, and people sort of deny that market forces are at work. I think they're just wrong, and we need our leaders to be doing the right thing for housing. And finally, great schools. The craziest thing is, like, people from all around the world come and try to set up their lives here in San Francisco, but then their kids have to go to private school to get a good education. And I'm not okay with that. Like, I grew up in the Bay Area, in great public schools. I grew up sometimes food insecure, and I was lucky to have a school that could teach me algebra in 8th grade, so I could take calculus, so I could study STEM at Stanford, and then sit up here and be in tech, period. Like, it is an incredible privilege and honor to work in tech. And I want that for everyone, and we should want that for everyone. And I think it comes back to voting for the right people.
All right, we're out of time, so I'm going to ask you one last yes or no question. Would you ever run for office?
Never. I want to be money in media. I think that's very scalable.
Fair enough. Well, we're out of time, so thank you so much for being here. And before you all get up and leave, we have one final word from our Pro Senior Editor, George Moriarty. Thank you so much.
Hello, everybody. Thank you for staying. 2 cards. I'm going to be fast. My name is George Moriarty. I'm the senior editor for Axios Pro Deals. I want to thank you all for coming. This was an amazing day. First thing first, I want to thank all of you in the audience. I want to thank the hundreds of you here who are going to go downstairs and drink together after this. And I want to thank the thousands of you who are able to watch the live streams online. We can't do this without you. Axios is audience first. You are the reason we get up and do what we do every day. Second, I want to thank our sponsors. We can't do any of this without them. Thank you, JP Morgan. Thank you, Latham & Watkins, for your continued partnership and supporting us as we bring the BFD out west. We are very excited to be here. I love this town, and I loved what Gary had to say about San Francisco. I think we should all give him a round of applause, and if he changes his mind, I will move to California to vote for him. All right, now, one classic Axios thing. This was a long afternoon, so you get 3 fun things to take away from today. First, I am the Irish son of Irish parents. Listening to John Collison so politely, yet clearly declined to answer questions, brought me home and a tear to my eye. Second thing, when Chip Bergh walked on stage, I did not expect him to be a skinny jean believer. And finally, not only does Vivek Radvive have great business sense and a passion for sports, he also clearly has great fashion sense. All right, so with that, let me thank my peers who moderated today. Dan Primack, the man who started all of this. Kia Kokolacheva, who joined him in starting all of this. Hope King, Aaron Brodwin from the pro team did a great job, and our publisher, Nick Johnston, breaking news with a view from the top with some of the comments from Anu. That was great. And also all of the Pro Deals reporters who put together such a great expert voice lunches. We had some amazing conversations. Look for coverage of that in your Axios Pro Deals newsletters soon. Finally, when you get a chance, check out that new Pro Deals tracker. I'm super excited about it. I think it's incredibly valuable and will be a huge value add for all of you. If you haven't already, subscribe to Axios Pro Deals. I have a vested interest. I have 3 kids in college. And I want to encourage all of you to subscribe to our free Business Suite newsletters so that you can be well informed quickly, get smarter faster every day, reading Pro Rata, Markets, Macro, and Closer by heading to axios.com/newsletters. Everybody, this was an amazing day. Thank you all so much. Go drink.